I love this company regardless of the economy, regardless of anything. It's just a great company. It's my belief. Karp is the main salesperson for Palantir. He's probably all over the place all the dang time. They can't imagine 3 years from now, 5 years from now, where these companies will be, what they'll be doing, those sorts of things. We're going to a $10 trillion plus company here. And I know these numbers sound big because we have no $10 trillion company. New retail investors are kind of at a breaking point in the market. They're like, is the stock market a scam? Is Bitcoin a scam? Ethereum a scam? Like everything's a scam because, you know, you haven't seen the success yet. This is just showing you kind of over the S&P 500 time. Many of these stocks got hit way harder. I don't think Zuckerberg really likes to leave Meta headquarters. Why does Zuckerberg need to fly all over the place? We're going to have some big IPOs coming. I'm sure Anthropic at some point is going to go public. I'm sure OpenAI at some point is going to go public. SpaceX at some point in time. Ladies and gentlemen, we have serious times out there. Looking at the public count and looking at the market in general, it is locked and loaded for a major move here. And people are wondering, okay, look at the public count, 3.5 mil. Are we going to take it down to 3.2 mil, which is where we're peaked at right before Liberation Day? Or are we going to head back to 4.2 mil and above, which is where the all-time high is in the public count? And we're going to discuss this in depth here today on exactly where this market is headed from here. What I'm showing you in front of you right now is a 3-month chart of Palantir, Bitcoin, Robinhood, Ethereum, Coinbase, and HIM stock. Okay, it has been a brutal time period for a lot of retail noobs in the market. A lot of retail noobs that got in the last, let's call it year, right? Stocks like this, assets like this, Bitcoin, Ethereum, right? They attract a lot of new investors to the market, right? They see people making a lot of money on those assets over the past several years, and they usually jump in very late to the bandwagon. And I mean, look at this. Palantir, 33% down the past 3 months. Bitcoin's down almost 40% the past 3 months. Robinhood's lost half of its value the past 3 months. 3 months. Ethereum's lost half of its value the past 3 months. Coinbase down over 52%, and HIM stock down 65% in the past 3 months. A lot of new retail investors are kind of at a breaking point in the market. They're like, is the stock market a scam? Is Bitcoin a scam? Ethereum a scam? Like everything's a scam because you haven't seen the success yet. You just see like down, right? No, even big retail stocks are awful right now. I'm talking the big dogs like Microsoft and Apple and all of those companies, Amazon, Tesla, Meta, Google, they're all doing horrible. Meanwhile, non-retail noob type stocks are doing amazing. Stocks like Walmart, Costco, Coca-Cola, Pepsi, Caterpillar, John Deere, Boeing, like GE, ExxonMobil, Chevron, J&J, like these are not popular retail stocks, not at all, right? Retail people that get in the market, they want to be in the growth, they want to be in tech. And it just seems like everywhere they turn is just down, all the way down to Chinatown, right? No flapjacks are being flipped anywhere. I put out this video on the reaction channel last night called My Favorite Stock Just Did What? I discussed in depth about Cheesecake Factory earnings in that particular video, right? I discussed other subjects as well, but Cheesecake was definitely, a big component of it, right? But, what do people say? They say, what about my favorite, AMD, right? People want me to just talk about AMD stock all the time, AMD or this company, right? Look at this. No one's interested in Cheesecake Factory. No one buys that crap. Do yourself a favor and take it out of your portfolio. The restaurant industry has the highest failure rate of any business and the lowest profit margins. Let's hear about AMD. That's the sort of sentiment we're talking about right now, right? People aren't listening to anything I'm trying to teach you. Like, I've kind of been doing this for a long time. I think you should maybe listen a little bit when I talk about GVD, when I talk about how to get through the bear markets and thrive in the bull markets. Like, I've been on this rodeo a long dang time, okay? 17 years now. Like, it might be valuable to understand, like, the method to the madness in regards to this, right? Look at a comment like this, and cake dropped like a rock after hours. I've had cake for over 2 years now. It's not really done much. I'm like, what are people talking about? It dropped like a rock after hours, and I think it finished green today, or almost green. So that's kind of funny. People tripping off of after hours moves, right? I don't know how that person could be down or it hasn't moved in 2 years. I think people just lie. Like literally, I just think people just throw random lies in the comments section sometimes. And I'm like, what are you talking about? The 1 year performances on cake is up 22%, and the 2 year and 3 year performance is up like 60 and 70%. And that doesn't even account for dividends received. Like, you should be up huge on cake over the past few years if you've been an investor in this stock. It's been a great stock. I'm up $75,000 on the stock in the public count alone. And from when I started buying this stock, right, in 2023, it's been over a double up. So I'm just like, I don't know, but that's the sentiment out there. Another retail stock that's getting slammed is SoFi. This stock just cannot catch a break. It's down almost 30% this year. Keep in mind, we're only a little over a month and a half through the year, and it's down almost 30%, right? I love SoFi personally. It's been a great stock for me. It made me 129% on the stock so far in the public count, right? But if you're a new investor in the market, a noob, right, and you bought SoFi last year at 30 plus, you're looking and you're like, SoFi stock's the worst stock in the world, right? Because it's $19 and you bought at 30 something, right? So this is like where perspective really comes in, right? I started on YouTube in 2016. 2017, channel starts to really get some traction, right? And I was awesome. Like, oh, Jeremy, this guy's awesome, right? 2018, we had a huge dip in the end of the year in 2018. And by then, 2018, I was the devil. I was a bad guy. Oh man, he's a bad guy, right? Then 2019 to 2021, he's a legend. Everybody loves me again, right? Oh my gosh, Jeremy, he's the greatest. Tesla, right? Those are the Tesla days when that was like a life-changing stock, right? Then 2022 comes along. He's a devil again, right? Market's doing bad. My stocks are doing bad. Public count gets hammered. Public count goes all the way down to right around $1 million even. I think it technically dipped just under $1 million at the low lows in 2022, right? He's a devil. Oh my gosh, everybody making fun of me. 2023 to 2025, he's a legend again. Everybody loves me. 2026, we'll see what happens, right? But this is not my first time on this rodeo. I want to say thank you to everybody that can think longer term. I call you guys the big brains, and people that think just short term, they're the bird brains. Okay, they can't think anywhere past like today and tomorrow. Like they just like think like they can't imagine 3 years from now, 5 years from now, 10 years from now, where these companies will be, what they'll be doing, those sorts of things, right? Just focus on the short term. Duolingo, little dingo, this is another perfect example of a retail traders type stock, right? Very popular on X, pretty popular here on YouTube as well, but definitely very popular on X, Duolingo. And look at this stock the past year. It's down almost 75% the past year. That's just brutal, right? In this video here today, we're going to discuss 3 subjects. First up, we're going to discuss every single stock in the public count. I mean, every single one. Sometimes people are like, oh, you haven't talked about this stock. And it's like, dude, I just talked about that stock 2 weeks ago, but okay, we'll talk about it again, okay? I'm going to talk about every single stock in the public count at the beginning of this video, just for at least 20 seconds, okay? I'll spend on them so I can just get that out of the way. Second subject up here, we're going to talk about how to keep a level head in a market like this and not end up screwing up your portfolio, your net worth, all those sorts of things, like I'm sure a lot of people are doing or have done. Third subject we're going to get up into in this video here today is where this market's headed from here. And I'm going to run you through the scenarios and how I personally see this playing out. Are we about to have an explosion to the upside for this market? And let's call it semiconductor stocks come back, big tech comes back, and maybe even some of these beaten down dogs, the SaaS plays start coming back, or are we actually headed a lot lower here? Okay, so we'll get into that. One thing all I need from you guys before we get rolling here, if you could just smash that little like button, I'd appreciate that in the biggest way here today. Additionally, make sure you're subscribe to the channel. You're definitely going to want to be subscribed here, okay? Alrighty, let's get rolling. Here it is. There's the public count. Okay, so public count. Let's just start talking about it right from the top. Meta stock, obviously great company. We all know that. A very attractive valuation right now. Spending ridiculous sums of money on CapEx. We all know that, right? They're gonna have to take hits on depreciation when it comes to that. It is what it is when it comes to Meta, right? Like the only thing bad you can say about Meta, literally the only thing, is how much they're spending on CapEx. Everything else is like on lock. They got WhatsApp, which obviously is starting to build into a major monetization engine. Instagram's as addictive as it's ever been, if not more addictive, right? Facebook continues to perform way better than anybody ever anticipated. Threads continues to build, which that's going to be a huge long-term monetization engine for the company. Meta glasses continue to take off in a significant way, and I have a little theory about Meta glasses that's going to help it even propel over the next few years. It seems to me like if you record something with Meta glasses and post that as like an Instagram reel, this is my hunch. I think they're promoting that stuff way more on Instagram, because I find so many times like the things that are getting shown to me on Instagram are something that was recorded with Meta glasses. So anyways, it's actually genius by Zuckerberg and the team if they're doing that. I mean, it could just be coincidence, but they have a great track record of tying products together. For instance, they did that with Facebook and Instagram back in the day. If you used Facebook and Instagram like 10 years ago, they did a phenomenal job of basically, if you're a Facebook user, getting you onto Instagram. Now they've done it with Instagram and Threads, and now it seems like they're kind of doing that same playbook, but with Meta glasses. So anyways, only thing bad you can say about them is the CapEx. The company's phenomenal. We all know it. Attractive valuation. Financials are great. Like, just great company. AMD is very, very exciting stock, obviously, for the next few years with the 400 series ramping this year. It's going to be a huge development for the company. Growth rates are going to go insane. Very exciting time. AMD is finally going to put up the sort of growth rates that really, really get people excited. And their growth rates have been good. They've been 30% plus. It's just they're about to take the top off in regards to this. So yeah, AMD, tremendous company, great financial statements. Obviously, Lisa Su leading the company. If the valuation might look a little expensive on like a trailing 12 month or forward P basis, but just keep in mind the profitability for the company is going to explode over the next several years in the margins as well. So it's not nearly as expensive as it might look on surface level. Okay. Amazon, great company. This is a very similar situation to Meta. The only bad thing you can say about this company, it's not around valuation, it's not around the income statement, it's not around the cash flow, it's not around the balance sheet. The only thing bad you can say is, oh my gosh, they're going to spend $200 billion on CapEx this year. That's it. Other than that, you got nothing. Their business model's as rock solid as could be. AWS growth is accelerating now. E-commerce business continues to be phenomenal. They're flipping international e-commerce to profitability. The advertising business continues to grow. Amazon's it's just such a great company long term. Short term, it is what it is. They're going to have a lot of depreciation that's going to hit because of all this CapEx over the next few years. It just is what it is. Like, there's no other, it's just, oh well. Like, Nike. Next one up here, Nike, the turnaround's clear as day to me now at this point in time. So now the stock price will follow over the next year or two. And I believe Nike's on its way back to $100+ a share. And that's a great company that I could feel very comfortable holding long term there, right? Cheesecake Factory, when it comes to cake, this stock, I spoke about it a lot in the past day because obviously their earnings came out, but their earnings are very good. Flower Child was very impressive, ladies and gentlemen. Flower Child is one of the big growth concepts this company has, and comps were up like 4% for the company in this latest quarter. Also, the operating margins, restaurant operating margins, if I recall, for the full year for Flower Child came at like 18.5%, if I recall. Very strong number in regards to that. They need to just grow more and more locations, like, immensely over the next few years, right? But yeah, Flower Child looks phenomenal. So cake overall could be, I think the numbers are going to get much better over the next year. Much, much better. Not that they're bad. It's just like they're going to take a level up from here over the next year, in my opinion. And that's why you saw the stock be very resilient today. Very, very resilient overall. Estee Lauder, this company, the turnaround's obvious now at this point in time. Up $75,000 on that stock. And that one's going to continue to perform very strong over the next several years, in my opinion. Great brands that company has in the cosmetic space, beauty space in general. Salesforce, this is one. I think these SaaS stocks are close to a bottom. I've been saying this the last week or two. They're close to a bottom. They might have reached bottom already, or they're very, very close. So I don't see there being significant downside. Like, if you're thinking, is there another 50% downside for these SaaS stocks? I don't see it. Could there be 10%? Sure, that's always a possibility. But yeah, Salesforce, great company. And that position, I feel very comfortable where I'm at there. Celsius, also a great company, up $78,000 on this particular stock. And Celsius is an energy drink company I feel very comfortable continuing to hold. They continue to build out that brand. They own Alani, which is a growth engine for the company. They got the Pepsi distribution, international expansion. Yeah, Celsius, great company. Palantir. So Palantir, been a great stock for me. Made 1,700%. I don't own that many shares anymore. It's a $134,000 position. If I still held all my shares, it'd probably be seven figures, if not multi-seven figures, right? But I took a ton of profits over the past year, like a ridiculous amount of profits. Palantir is a great company though, but they got two problems with Palantir. One is valuation, although that has come down immensely from where the stock was. It was a $200+ stock. So all the metrics have gotten more attractive now, trailing 12-month P, forward P, price to sales ratio, forward price to sales ratio, everything like that. But it's still a highly valued stock, right? But the bigger issue is we have elections coming up. Palantir seems like it could be a lightning rod in terms of being somebody to point at and say those are the bad guys, and starting to look over all their government contracts. It's going to be messy. Palantir is going to have dark clouds around it for a while. And so, that just is what it is. And that's why I said years ago, I wouldn't mind them splitting the defense business from the commercial business. I said that years ago. And the reason being is, the reason I invested in a Palantir stock years ago is because of the commercial business. Because I'm like, that's going to dwarf the defense business, and that's going to become so massive. And the thing that's going to be a holdup of the company or give them a bad name and make them a lightning rod when it comes to, they're, surveilling us. They're keeping track of all of us, right? They're enemy of the people. That's going to be because of the government-related contracts, right? Which is actually, a very small amount of the business when you consider how rapidly the commercial side of the business is growing. So anyways, it is what it is. But Palantir is still, at the end of the day, you look at the financial statements, they're among the best you'll see literally out there. The income statement, the balance sheet, oh my gosh, it's ridiculous. Adobe, this is one that I think is also close to a bottom. I think the forward P is now down to 10 or 11 on this company. They're not being replaced. I know, they're they're going to be replaced. No, they're not. Working in big companies that have to use Adobe's products, they're not being replaced. PayPal, obviously it's been a tough stock, down 24% on it. Yeah, it's been a value trap overall. Everything's been up and to the right when it comes to, revenue, profits, all that good stuff, but it's been a value trap. Forward P now is 7. So I don't think there's much downside left in PayPal. But then again, I could have said the same when PayPal was at a forward P of 10 or 11, right? It's just ridiculous. But anyways, it is what it is. The company's a great company, though. There's no debating that. The stock sucks, right? It's down 24% for me. But the company's great. They got returning users who continue to use their products like PayPal and Venmo again and again and again. Their total payment volume continues to climb. Their revenue continues to climb. Their profits continue to climb. They make so much money. It's an ATM machine of a company. I mean, they just make ridiculous sums of money, and then they go buy back tons of shares, which then helps their earnings per share grow at even a faster clip. So, but anyways, that doesn't mean the stock's going up. It's just been a brutal stock. It's been a complete value trap. That's what PayPal's been, right? ServiceNow, so far we're up on this position. It's a very new position for me, as in I bought it now. It's a very new position. $6,000 up here. ServiceNow is very, I don't think people understand how intertwined ServiceNow is with big companies. And that's another one, people aren't just ditching ServiceNow. It's just ridiculous, man. People... Crazy. American Express. This is a stock I really love for the long term. This is one kind of like a Nike or even an EL that I could build out to be a big position, hold for years to go into the future, right? Their credit card business is unbelievable, and they have the clientele base that you really want to have. So they're a tough company to beat in that space, and I don't see them being disrupted anytime soon for a long time. SoFi. Great performer for me overall. Great company, great numbers. Anthony Noto's doing a heck of a job leading the company. And once the market gets moving up again, SoFi's going to go flying. It'll go right back to $25, $30 a share. But we have a very big market malaise right now. We got risk off going on. And so SoFi just can't perform in that sort of market. It is what it is. Elf on a shelf. Man, I love this company regardless of the economy, regardless of who's president, regardless of anything. It's just a great company. It's one you got to own in the cosmetic space. People say it's a boring stock. It's up 1,151% from when I invested in the stock. And, I think the stock's on its way to 200 plus over the next 2 or 3 years. If that's boring, I guess I like boring stocks. What can I say? Google, McDougal. This one I took a ton of profits on very recently in regards to Google and redeployed that into some other positions. Google's just reached Google's got two issues now at this point in time. Google one issue for Google is valuation. The valuation's climbed quite a bit on Google. It's not like it's out of control. It's not like it's a Palantir situation where it's like, this is crazy value. No, but we do have to admit, like the forward P has gotten very elevated compared to where it was a year ago, right? Second thing is another major CapEx spender, like spending ridiculous sums of money. So that's Google McDougal. Honest, this one's been a brutal stock for me, down 44K on this one. But the company, the financials look great. So, I don't have a lot to add to Honest. Like, I don't know if somebody wants like some magic thing here, but the financial statements look great. The income statement looks great. The balance sheet looks great. Everything's been continuing to improve for the company. Yeah, they're getting out of some product categories that were, negative for margins. But man, I think Carla's doing a good job setting up the company for long-term success. Remember, this company was nearly bankrupt when she took it over, and you look at the company now and you're like, dude, this is actually a pretty impressive company. So anyways, a $2 chuck, but I like it for the long term. Short term, who knows? Like maybe it goes back to $1. That would just be silly. It's not a bankruptcy candidate. Back when, this stock should not be trading under $5. That's the way I'll put it. Like you're under $5, it's because you're a bankruptcy candidate. And Honest is just not a bankruptcy candidate at all. Revolve, this company up 124% on this one. Small position for me overall, $50,000 position. Very impressive company in the e-commerce space. They continue to be a nice growing company that puts up great financial statements. Then I have my Tesla hedge here. Fidelity split it into two, but it's the same exact Tesla hedge essentially. But yeah, TSLZ, holding for now. That's what I'll say about that. Fubo TV. So Fubo is a dollar stock. Very small position for me. It's $25,000 position in the public count. It could go bankrupt and it's like, a rounding error, right? But when it comes to Fubo, I think they have huge long-term potential at that company. I don't think investors understand, and this is management's fault in my opinion. Management's got to do a better job of this by the end of this year, but they got to explain exactly what Fubo's up to, exactly what they're going after. I don't think investors understand what the heck Fubo's up to. Like, are they trying to focus on growth moving forward? Are they going to try to focus on profitability and margins going forward? Like, with the Disney partnership and, that connection now with Hulu Plus Live TV, I think it's very hard for people to grasp. Like, are we going to go after YouTube TV and try to take the number one spot? Or are we going to concede and just be cool with being like a number 2 or number 3 player in the market, but being very profitable? Like, what are we up to here? Once investors have more clarity on that, I think the stock will start to be bought. But in the short term, it's just, just kind of a messy situation, right? I don't think it should be trading at $1. That's just ridiculous. Now, in terms of profits I've taken so far in the public count in 2026, we've taken $37,000 in short-term gains so far this year and $314,000 in long-term gains in the public count so far. And then last year took $532,000 in long-term gains in the public count and took $48,000 in short-term gains in the public count. So it's been a heck of a time. Okay. Alrighty, next one up here. How do you keep your head in a market like this and not end up going flipping your flapjacks all over the place? Okay. Listen, I put this little illustration together several years ago, right? It's called Jeremy Lefebvre's Hotel, the Flapjack Flipper Resort, right? And it's a 1000x resort. So it's a little funny thing I put together, but it's like very serious at the same time. Build a portfolio to be proud of years from now. Like this is where your focus needs to be, right? Building stocks, building ownership in companies that you're going to be proud you bought years from now. You're like, dang, I'm happy I bought that stock, right? Like it's a great company, great financials, attractive valuation. Staying diversified is your alpha long term. This is how it does, I could have any stock fail in the public account. And when I say fail, I mean go to zero. Robert De Niro, Last Action Hero. And we're okay. It doesn't like Meta could go to zero. Obviously super unrealistic. Amazon could go to zero. AMD could go to zero. We'll be fine. That's because I stay diversified. There's no one stock that makes or breaks me in the portfolio. A lot of people invest in a very silly way. They go all in a stock, all in 2 stocks. You can do that, but boy, you're setting yourself up for problems. You're not diversified, right? Growth, value, dividends, hedge, cash, right? I always keep some cash around. I don't have to sweat it in terms of like thinking about, oh, I need to go buy something, like let me sell stocks, right? Or I need to do this, let me go sell stocks. No. That's why you keep cash around, right? Hedging is important more if you're a higher net worth individual. Growth, value, dividends, every investor should be doing this. Growth, value, dividends. What do I call it? GVD. GVD 1, 2, 3. You need to be adding multiple stocks that are growth stocks, multiple stocks that are value stocks, and multiple stocks that are dividend stocks to a portfolio, and continue to build those out as the years tick on. You don't just get into one stock and that's it. And that's where a lot of, retail folks have gotten wrecked the last, let's call it 3 to 6 months, because imagine you're like just into the hype stock. So you get in the market last year, you buy Palantir, you buy Coinbase, you buy Robinhood, you buy Bitcoin, you buy Ethereum, right? And now you're down 50, 70% on all those assets already. And the market's near at all-time highs. What do you think is going to happen if the market goes south? Like, what is going to happen to you if the S&P 500 goes down like 20 or 30%? Like, gosh, come on, man. You're wrecked. You're done. You're done for, right? So that's that. Conference calls are non-negotiable. You got to listen to conference calls. You're going to get so much good data in that. I was listening to Cheesecake call. I got several key points of data that make me more confident in cake than I even was before. This is so important, man. You got to listen to conference calls. You can listen to them straight through 1000xstocks.com, which is my advanced software I have. And everybody that's part of my private stock group gets access to that. That will be pinned comment down there if you want access to that. If you also want to listen to conference calls, you can go search company's investor relations page. You might have to surf around a bunch for it, but you can find them on company's investor relations pages as well, right? Know your stock's financials and know your stock's metrics. You gotta know this stuff, man. If you don't know how to decipher an income statement, a balance sheet, a cash flow, how can you hold through the tough times? If you don't know how to properly value companies and understand why a company deserves this forward P versus this forward P, and why this company should be at this trailing 12-month P and price to sales ratio, if you don't know how to do that stuff, the private group's there for you. I can teach you all this stuff. It's light work, man. It's light work. I got all the course curriculums teaching you all this stuff. In a matter of a week or two, you can go through those course curriculums and get up to such a high level than where you're at right now. Teaching this, like, oh, that's how you do it. Okay, you do it like this. Okay. Like, dude, like literally like 2 weeks of going through those course curriculums, you would be shocked at like how much knowledge you'd gain by just going through that. Pin comment down there. You can apply to join, or you can, keep gambling money around. It's up to you. You do what you want to do, right? Outwork and outsmart. That's what we do, every day. I was listening to that cake call last night at like midnight. Outwork and outsmart. Buy the dip, never trip. Don't, get all crazy about the market, right? And when it comes to a private group, that's a calm, cool, collected bunch I have in there. 6, 7, 8-figure investors. And they've all been trained by me. They're not like tripping like, some of these people on X and YouTube, and they're freaking out because their stocks are down 40, 50, 60, 70%. The portfolio's been decimated. The portfolio's a fraction of what it was 3 months ago or 6 months ago, right? You're in a tougher market, like, yeah, your portfolio gets hit. That's fine. That's all part of it. It's like the ocean tide going in and out. Like, it's natural. It's like the season's changing. Like, oh, it's wintertime now. Oh, now it's springtime. Oh, now it's summertime. Now it's fall. That's natural. That's what happens. It's like rain sometimes. Like, it's raining here in Vegas today. Sometimes it rains. Like, that's natural. And other times it's sunny. That's natural. And so when you talk about the market and your portfolio fluctuations, it's all normal. If you've been trained properly and you're in the right mindset mentality, this is not hard for you to understand. So anyways, if you want to get up to a much higher level, that will be the pinned comment down there. Let's get you to a higher level, because a lot of people could use my trainings because they're not in a good place mentally when it comes to this stuff, and they have no clue what they're doing. They're gambling money, and now their portfolios are down 60 and 70%. And they're like, oh, I probably should have learned a little something, right? Okay, now from here, let's talk about where this market is headed, okay? So, remember at the beginning of the video, we talked about the 3-month of many of these like retail noob type stocks, right? Palantir, Bitcoin, Robinhood, Ethereum, Coinbase, HIMS, these sorts of things, right? These sorts of assets, right? High beta, hype, risk on, those always get hit first. So if you think about things like Bitcoin, things like Ethereum, like that's the type of stuff that gets hit first when you're starting to go through some sort of market downturn, right? It's always the way it is. It's just that stuff gets taken out first and gets thrown out. There's no other way about it. Like, that's always going to see the damage first before you see the damage in anything else, right? And because those are high flyers, a lot of people have made a lot of money in those and take profits and things like that, right? Look at something like a MicroStrategy, MSTR. I call it micro tragedy. Might be a macro tragedy soon. Look at this. It's down 76% from its all-time high. 76%, right? But this is something that, people, I'm sure last year were buying up because it was like Bitcoin, let's go to the moon, right? And MicroStrategy is going to go so much. You know how much you need MicroStrategy stock to go up to get back to, you need it to go up way more than 76%. Like anybody that knows anything about math, like you understand that, right? It's not like, oh, it's down 76%. Now if it goes up 76%, I get back to break even. No, it's not how the math works on that. So just something to keep in mind. Look at something like this one, BMNR. This was a very popular one. They call it the Ethereum MicroStrategy, right? If I recall, Tom Lee is in relation to this one, right? Look at this baby. It's down 87%. 87%. Somebody was paying $161 for this back in July of last year. Back in July of this past year, somebody was paying $161. And if they sold it today, they get $19 for it, right? That's damage. That's damage. So this really shows you that these risk on type things, high beta, they really get hit hard first before anything else, okay? No, what I'm showing you right now in front of you is this is since Christmas. And what we're starting to see is we've seen a lot of damage in super high quality but higher valuation type stocks. Those would include companies like Palo Alto Networks down 19%, companies like Shopify down 27%, companies like ServiceNow down about 30%, companies like Salesforce down about 30%. All these type of stocks are some of the most high quality stocks in the stock market over the past decade, right? But they have higher valuations on them traditionally, very high usually price to sales ratios, PE ratios. So those are the next that end up getting hit after the more speculative high valuation things get hit, right? Then it's like super high quality, higher valuation. So that's happened now at this point in time, right? Meanwhile, while you have all this damage occurring, you have things doing well that you're like, what? Like utilities, like energy stocks, basic materials, these sorts of things can actually perform well while everybody's getting slapped out there on all these other more risk-on assets. Look at things like Walmart, things like Costco, Coca-Cola, Pepsi, right? Boeing, Caterpillar, Lockheed Martin, John Deere, Procter & Gamble, Johnson & Johnson, CSX Railroad, Union Pacific. They're all hiding out in these sorts of things. So these things are doing great. Like they're like, wait, y'all are getting damaged? We got a bull market going on over here. We got a bull market in Walmart stock, right? So that's what you have going on. You have money hiding out in these sorts of places, and it's not in MicroStrategy right now. It's not in BMNR or whatever, right? It's not even in these super high quality, higher valuation names. It's not Robinhood. It's not Coinbase. It's hiding out in Walmart stock, right? So that's what you have going on here, right? No, we saw this exact playbook play out in 2022. And if you were with me in 2022, you saw this actually game plan play out back then in 2022, okay? So, before we get to 2022, I want to show you this because it's very important, okay? This is year to date of big dog stocks, right? Nvidia is down for the year, Meta's down for the year, Google's down about 4% for the year, Apple's down 4% for the year, Tesla's down 6% for the year, AMD's down 9% for the year, Amazon is down almost 10% for the year, and Mr. Softy, Microsoft's down about 16% for the year, right? That's year to date. So that's usually the last thing to get hit outside of the hideout stocks like Walmart and all those others, right? Once those stocks get hit, everything got hit, right? But I want to show you this, okay? This is 2022 because I brought that up for reference. At this point in 2022, the S&P 500 got hit, but it wasn't like that bad. The S&P 500 was down 8%. Meanwhile, Google was down 8.8%. Amazon was down 9%. Mr. Softy, Microsoft was down 13%. Nvidia was down 18%. SoFi was down 22%. Coinbase was down 23%. AMD was down 25%. Tesla was down 27%. Robinhood was down 33.5%. Palantir was down 36.5%. At this point, from basically 2022 start to this point, February in 2022, right? Now, this goes to show you there was some damage in the market, but it wasn't that extreme. The big damage was actually in a lot of the riskier type stocks. They're what would be seen as riskier. And keep in mind, these stocks had already gotten obliterated. Many of these stocks had already gotten obliterated because they peaked way in 2021, essentially, right? Now, by the end of the show, look where the damage was. S&P 500 at the lows was down, I think, around 25% roughly. Here on the chart, I have it at 24%, but I think it was down around 25%, if I recall, from like peak to trough, like 2021 peak to 2022 trough. Lost about a quarter of its value, right? Apple actually held up well during that whole drama. Very, very well. Meanwhile, Microsoft stock fell 33%. Google stock fell 35%. Amazon stock fell about 40%. Tesla stock fell over 40%. Nvidia stock fell 62%. AMD fell 63%. Palantir fell almost 70%. Robinhood fell over 70%. SoFi fell 77%. Coinbase fell 81%. Keep in mind, when it comes to all these stocks, this is not their peak to troughs. This is just showing you kind of over the S&P 500 time. Many of these stocks got hit way harder. Like peak to trough, for instance, like Tesla was like a 70% fall. So, it shows here like it was actually way worse than this, okay? Way, way worse than this, right? So there's two ways I see this market going from here when it comes to upside and downside. Let me tell you what I see as being the most realistic possibility from here, and then we'll talk about the one that's less, okay? So this is a 60% probability I see, okay? So this is a higher probability, and this is what gets the market out of this funk, okay? This is how it plays out. First, Nvidia reports earnings next week, okay? So Nvidia reports, they don't just come in and beat numbers, they smash numbers, smash guidance. Like it's a smash factory. Nvidia hasn't really been smash factory recently. It's been like the company, it's like, oh, they're beating numbers, but it's not like, whoa. Nvidia comes in and just smash factory. Banger quarter, dramatically better than expected, which is a possibility because I'm looking at these CapEx numbers for these companies. I'm like, it's a possibility that Nvidia does do way better, dramatically better than anybody anticipates. Okay, so that gets, guess what? That gets a lot of the semiconductor stocks, the chip stocks, that gets them to start to fly. Momentum comes back. Momentum comes back into Nvidia. Momentum comes back into AMD. And those stocks have kind of been in a malaise for a while. Boom. Okay, an upward swing happens there. 3 weeks after that, Micron reports earnings. If Micron comes in with a shock and awe guidance number, which is very possible with what's going on with the pricing there, we could talk about more momentum. Yeah, it comes into the chip stocks, right? And kind of gets those at least out of this malaise and maybe up to, gets those stocks to either all-time highs or close to all-time highs, okay? From there, AMD hype starts to build. Obviously, in summertime, we have likely AMD 400 series going into major production. That's going to be a huge, huge development for the company. That hype really starts to build as you get into the springtime, right? Because keep in mind, we're talking about Nvidia reports next week and then 4 weeks later. Now we're talking about we're already pushing close to the beginning of spring, right? So the hype starts to build because it's like, oh, summer, big production's coming for Nvidia. There starts to be a lot of excitement that comes into that, right? Which pushes up AMD in a major way, right? And then late April, we get Amazon earnings again, Meta earnings. If those sorts of companies come in with like banger quarters, and when I say banger quarters, I'm talking about AWS reporting an AWS growth number way better than people expect, and a guide way better than people expect. Same thing with Meta. Meta, I think analysts are at like 31% revenue growth. Meta comes in with like a 35, 37% revenue growth number. Off to the races. And then that starts to push up Mag 7 again. And then you have the whole show moving, right? And so it starts with like I call it like the match could be Nvidia, right? Like the match is Nvidia, and then Micron, AMD, that situation, that could be, let's call it, add some fuel to the fire. And then if Amazon and Meta could come in with bangers in the springtime, when it comes to those growth weights, way better than people anticipate, not just beating numbers, but like handily beating numbers, then we're talking, we got the whole show is on fire then at that point in time, right? So this is the highest probability I see, 60%, but let me run you through 40%, okay? 40%, listen, 40% is not bad, right? Like the 40% scenario, hey, you get to buy a bunch of stocks for a way cheaper price than what you can get them at today. It's not like there's always good in everything. It's like the 60% scenario, okay, we may get to make a bunch of money and go back to all-time highs in our portfolios and then break new all-time highs. Okay, that's fun. 40% probability, it's still a win. You know why? Because then we get to buy stocks for very, very cheap prices. And as long as you got more income than expenses, which is number one key to being a successful investor, great, right? But this is a 40% probability. Geopolitics flare up, right? The whole Iran situation, I don't know. We'll see what happens with that. You have that all of a sudden, let's say that goes messy. Then you have Nvidia come in with their report next week, and let's say it's just a meh. So they beat numbers, but it's not that big of beats. The guidance is good, but it's not that crazy. If they just came in with a, okay, that's not going to add any like excitement into chip stocks, right? Then you have that. So then people are still worried, have the CapEx worries, right? About these companies are spending so much, right? SaaS worries are still there. And then you get Bitcoin, Ethereum worries, and those are going lower, and Bitcoin's going to break 50K and all this stuff. And so that's a possibility too, right? And that's why I have it at a 40% probability. But you get to buy stocks for cheap, right? And so it's not always the worst scenario, right? Now, don't try to time this market, right? Own great companies. This is a great example. And like I said, people just leave comments sometimes, and I just, sometimes they're just straight up lying, right? And I appreciate, by the way, everybody that always leaves nice comments, and, because I read through them, and I appreciate all the nice words, and, if you guys ever have subjects you would like me to speak about and things like that. But like sometimes, man, I'm just like, people got to be lying, or they're just not looking at the market right? This comment, Cake, sold at 65. Oh, really? You sold at 65? When? When did you sell at 65? That's interesting. Did not like this quarter. Sales down, weather as an excuse. I'll buy back sub 50. What? Really? You're going to buy back sub 50? So you know it's going under 50. You must be the greatest trader in the world. Why would you buy back? If you don't like the quarter and, you don't like the company, you must not like the company because you sold at 65 supposedly, right? Supposedly you sold at 65. You must not like the company. And then you don't like the quarter, so why are you even going to buy back? It doesn't make sense. Like, you want to stay out. And at that point in time, why the heck would you buy back? It doesn't make sense, right? Unless you're trading stocks, which if you're just trading in and out stocks, you're gambling, right? Like, that's not the way to do this game. That's not the way to do this game. That's not the way to the Ferrari. That's not the way to the big house. I can tell you that much, okay? If you're ready to take your game up to a much higher level than where you're at, join my private group, apply to join it. That will be the pinned comment down there. Fill out the form. Let's see if you're a good fit to join us in there and get you, like, literally, you can go through the course curriculums in a matter of a few weeks and just get yourself up to so much of a higher level than where you're at right now. And then you'll be like, I'm glad I joined this place. And then you get the community aspect. You get access to 1000xstocks.com, which is what I use on a daily basis. It's amazing. My favorite stock, not my biggest position, but my favorite stock, Cake, just came out with earnings right now. I want to talk about what's going on here. We're going to talk about the stock. We're going to talk about, is this stock on its way to $70+ a share? Are we on the way to $50 a share? All that good stuff. Palantir, another investment of mine. I've taken the far majority of profits in the stock, but it's still an important position for me. Probably multi-six figures if you add it up across my portfolios. They are in a bunch of drama here today, okay, regarding Alex Karp's jet and the use of that, regarding taxes and all that. Oh my gosh, okay, so we'll talk about Palantir and what's going on there, okay, and I'll share my opinion and perspectives on if it matters for the stock. From there, I want to react to this 3-minute clip. Tom Lee went on CNBC here today, shared his opinions and perspectives on where this market's headed from here. Mohammed El-Erian spoke about what he expects for the market, including a lot of volatility. We'll share, kind of my thoughts in regards to that. And then we're going to get in this one. Mike Wilson used to be a big bear back in the day, but I guess not so much anymore. Mike Wilson says AI cycle is just getting going. So looking forward to reacting to that. Little 3-minute clip there. A lot to get into in this video here today. Appreciate y'all for joining me. One thing only I need from you. If you could just smash that little like button, I'd appreciate that in the biggest way. Additionally, if you want to make sure you're subscribed to the channel, put notifications on, all that good stuff, okay? Alrighty, so Cake, let's get going here right off the bat with Cake. What's going on here? Well, listen, it wasn't a good quarter in my opinion for Cake overall, okay? I gave them a C- grade in regards to this. The revenue went to 961 mil from 920. That's good. Food and beverage costs dropped as a percent of revenue. Also very good. Labor expense dropped as a percent of revenue. Also very good. And then other operating costs and expenses also dropped as a percent of revenue. Those are all great things. That's what you want to see. However, general administrative expenses was really high. That went to 7% of revenue. That was up like $10 million, roughly $9.5 million year over year, right? Depreciation and amortization, that went up a bit here. But then you had this kind of weird line item here. Impairment of assets or lease termination expenses expenses, acquisition related, contingent considerations, compensation, amortization of expenses. This was up 2.3%, and then this one was up this one was up to 2.3% of revenue from 1.7%, and then this one was a big boom here. This went to 1.2% of revenue from basically, it was actually a help in this quarter last year. Also, pre-opening cost was also up quite a bit year over year, almost $2 million up there. So expenses ended up going very high here to 96.5%, but it's a lot of like weird kind of more one-off type things here. So just do keep that in mind. Like part of this had to do with this like gift card situation, which we'll talk about here in a moment. So income from operations fell to 3.5% from 5.1%. Diluted EPS 60 cents versus 83 cents in the same quarter last year, right? But the thing to keep in mind here, right, is there had a bunch of weird things here, okay? Impairment of assets and lease termination expenses. This is not something that usually reoccurs, okay? Especially in terms of this sort of big number like this. They had this gift card adjustment that hurt them by almost $9.4 million there. They had tax effect of adjustments as well, right? So if you adjust on a non-GAAP basis, their net income would have been $48 million. Now that's still versus $51 million in the same quarter last year, so it's still down, but it's not as bad as it looks, right? So it certainly wasn't the strongest quarter from Cake, and I think a lot of people kind of expected that, just to be honest, in regards to not being the strongest quarter for Cake. And I think that's why you saw a little weakness in Cake stock early in the fourth quarter last year. And a lot of that went back to like the government being shut down and, that potentially hurting sales and other factors as well, right? So that's just something to kind of keep in mind there. Now, the most important part of their presentation here that they did for investors, they talk about North Italia, right? This is a very exciting concept that's growing immensely for the company overall, right? But this one had a bad quarter for them overall, I would say. Basically, the latest quarter comps sales on a quarter over quarter basis, or a quarter, basically this versus this quarter last year, it's down 4%. So wasn't a good, impressive quarter from North Italia. Keep in mind, still likely a very profitable concept and doing very well overall, but the comp sales were not good in the quarter. As far as Flower Child goes, they don't break out those specific numbers, but this remains a huge growth vector for the business over time. About 50% of the business is basically off-premise, or like, people take it to go, delivery, those sorts of things. And from my understanding, they're still only exclusive with DoorDash. So if they ever open that up, there's more opportunity there, right? Potential for 700 domestic locations over time. As of right now, they only have 43 locations. So a lot of expansion opportunity there. As far as Fox Restaurant Concepts, they have a lot of growth concepts coming here, essentially. 55 locations right now. And as far as what they did for revenue for this side of the business, $355 million last year. And they're across 11 states, right? This really shows you, obviously, Cheesecake Factory, that's their big ATM machine. North Italia and Flower Child are the ones that are expanding across the United States. And then Culinary Dropout, Blanco, the Henry, those are ones that are more testing in different markets right now. Now, this is disappointing in my personal opinion. They're talking about only 26 new units in 2026. I'm not happy with this. They opened 25 units in 2025. I just don't think they're opening nearly enough concepts, especially in regards to Flower Child. They need to be opening up 26 Flower Childs a year. Like, with how few Flower Childs they're opening, like for instance, last year, they only opened 6 Flower Child locations. Okay, you believe Flower Child is going to be 700 locations, right? We're at 43. Do the math on that. How many? We're going to be opening Flower Childs till, AI takes over. Come on, man. We got to get going here. With Flower Child, we cannot open 6 concepts a year. That's ridiculous. Flower Child needs to be opening 20 to 30 concepts a year in and year out, like clockwork. 6 concepts is not going to cut it, man. No, it's just ridiculous. They're just going way too slow in regards to this. When you got a hit concept, you need to be like Chipotle wasn't like, we're going to only open 6 Chipotles a year. No. When it was obvious they got a hit concept there, and they were expanding it rapidly, right? We got a hit concept here with Flower Child. We got to go faster than 6, new units a year. Like, it's just ridiculous, man. So this is one area that I'm definitely, I would say, not happy with Cake about. Like, we've got to move faster. We got to hit, man. We got to hit. Like, let's go. Let's get this out there, man. So that's my 2 cents on that, right? Now, as far as fiscal year goes, FRC was basically flat with sales. Cake was very, very slightly, and North Italia was negative 2%. So I would say it was kind of a disappointing year for North Italia. You always want to see any of your restaurant concepts growing, and especially North Italia. It was a disappointing, I would say, year for North Italia, right? As far as fiscal year 2025 highlights, revenue was up 5% year over year. Net income was down 5%, but keep in mind there was a bunch of weird things up there in that, right? Adjusted EBITDA came in at $354 million. That was up 8% from the previous year, which is a very nice number, adjusted EBITDA there, right? Remember, a company like Cake takes big depreciation and amortization all the time, right? Diluted EPS down 4% versus last year, but adjusted diluted EPS was actually up 10% versus the previous year. So, like I said, they had a lot of weird things that just, kind of hurt profitability on a GAAP basis, but you back those things out on a non-GAAP basis, and it actually looks a lot better than, on a GAAP basis there. Capital allocation, $146 million in CapEx. $52 million in dividends. They did just up their dividend as well. They're given another 3 cents a share per quarter, essentially, which I'll gladly take that, right? $154 million in repurchases. As far as 2026, talking about consolidated sales of approximately $3.9 billion. I think they should be closer to $4 billion, in my personal opinion. Net income margin, they're targeting 5% of basically that revenue there. So keep that in mind. New unit growth. Look at this, man. This is the most disappointing thing for me. 6 Cheesecake Factories, only 6 to 7 North Italias, and only 6 to 7 Flower Childs. I'm like, what are we doing here? What are we doing, man? We got to hit concept. We got to move faster on Flower Child, in my opinion. Got to move faster. So, yeah. Got to move faster, man. Like somebody's got to get a hold of the management team and be like, dudes, we got to get moving on Flower Child. This is just unacceptable. 6 to 7 units, we got to hit. What are we doing? We got to go faster than this, man. Got to go faster than this. So I hope somebody can get a hold of management and be like, what do we need to put in place so we can start growing Flower Child at 20 to 30 concepts a year in and year out, right? And even that still isn't like a crazy number. It's not like it's like, oh my gosh, like 20 to 30 concepts. That's like such a high number. That's not that crazy. Chipotle, from last time I checked on Chipotle, which has been a bit, but last time I checked, Chipotle was expanding like 300 concepts a year, 300 locations, right? So to get to 20 to 30 isn't like some like, whoa, this is crazy. Can you believe this? 20 concepts, like 30 new locations. So we got to get moving. So that's my 2 cents in regards to Cake here. Overall, they're talking about the annual growth outlook. They're talking about 1 to 2% comp store sales being up, and they're talking about top line 7 to 8% revenue growth. So that's their average annual growth targets they're targeting, which I think is very, very possible, which would be very good numbers overall. Okay, so let me see how the heck I get out of this now that I'm in this dang thing. How do I get out? There we go. I'm out. Okay. So Cake overall, in the short term, I don't know, anything's possible in this stock. The long term, the company set up very well. I'm just walked away a little disappointed. It wasn't the strongest quarter, and we're just opening Flower Child concepts way too slow. So what are we going to be at the end of this year? 50 Flower Childs? 50 Flower Childs? We're talking about going to 700? We gotta move, man. Move. So let's hope we can get a hold of management team and get them to get open some more Flower Childs, man. We gotta get rolling here. Alrighty. Next up here. Oh, by the way, will I be buying Cake stock or selling Cake stock? Definitely not selling. If anything, I'm buying more. Let me say this. You want to know how Cake goes to 100 quick? Management's got to open more Flower Childs. If all of a sudden they announce, they're going to start trying to open 20, 30, 40 Flower Childs a year, like that's our goal in the next, year or two to get to that place where they can start doing that consistently per year and do it on a high level, watch the stock explode. Watch this stock watch it go to 100 like that. So But anyways, we'll see. All right, Palantir's next up here. So, Cassandra. Out there. Oh, okay. Alex Karp. So what happened here during the years ended December 31st, 2025 and 2024, company incurred expenses related to the executive aircraft of $17.2 million and $7.7 million. It's quite a feat to spend $17.2 million in a year on business and personal travel, particularly when the jet's not even a rental, says this gentleman, Brent Phil, right? Assuming use of a mid-sized jet, okay, Big Dog Karp's probably flying on a G650. So at an estimated $15,000 per hour, the $17.2 million still equates to approximately 1,147 flight hours, or 13% of the year flying around. Listen, my guess is Karp is flying around like a beast, okay? I believe, it's my belief, Karp is the main salesperson for Palantir. Like literally, I think he's the main person by a mile that closes deals for Palantir. Not kidding. So he's probably all over the place all the dang time. So is the number high? Yeah, it's high. But it's, they try to compare it versus Zuckerberg. I don't think Zuckerberg really likes to leave Meta headquarters. I could picture Zuck being down there as much as possible. I don't think Zuckerberg wants to why does Zuckerberg need to fly all over the place? He doesn't need to close deals. Zuckerberg needs to be in the office at Meta headquarters every day, right? This is very different than Karp. Karp needs to actually not be at the headquarters. Karp needs to be out on the road constantly, going to meet with big customers, closing deals. So to compare it to Zuckerberg, I just think it's a bad comp. Probably the only time Zuckerberg really has to travel is when he has to go speak to these politicians because they question him like they were today, right? That's very different. Very, very different. So, but anyways, is the number high? Sure, the number's high, but is it so outrageously high that it's oh my God? I think they're kind of grasping for straws at this point in time. And, the company's growth rates are ridiculous. Now, this is another thing that people are mad about. Palantir paid zero federal income tax in fiscal year 2025, despite having $1.5 billion in income, right? Listen, the company lost a lot of money for a lot of years, right? You're going to have rollover from that. But you'll see this sort of sentiment. Teachers can only write off up to $300 of their classroom expenses on their taxes, but the worst, most harmful companies in the United States can write off whatever expenses like private jets and yachts and business losses they want in order to pay nothing, right? So this is the issue with Palantir, man. Palantir is definitely a public enemy, right? And, Financial Times, look at the picture they use. It's clear they're a public enemy. They're going to be used likely in this next election cycle here as an enemy. Contracts are probably going to have to get reviewed. It's a whole situation. So Palantir, they're going to be in the storm for a bit. And as a Palantir shareholder, you got to understand that. They're not going to be getting out of this storm short term. It's just not. And I've been through companies that have to go through the storm, and it's painful, as I've had to go through Meta in the past. Meta was through a whole huge storm. Politicians were looking into them all the time, and governments, and they had to pay these big fees and fines and all this stuff. And so with a company like Palantir, just understand they're going to be in the storm for a bit. And if you want to be a Palantir shareholder for the long term, you just have to be okay with that. Because this storm's not ending tomorrow. If you're hoping this all goes away and everybody stops paying attention to Palantir and looking at them from a negative light, it's just not happening. They're going to be seen in a negative light for a while. You got somebody like Burry out there, trying to look at everything from a negative angle. They're trying to dive into everything. Karp spent too much on private jets last year. They're just going to look at everything. So, anyways, just something to keep in mind here, okay? Alrighty, let's get into Tom Lee.
Research, as I said, right there at Post 9. It's good to see you.
Great to see you, Scott.
So you think we're going to 7,300?
By the way, before we get rolling here, pinned comment down there if you're looking to apply to join my private group, which is access to all my premium course curriculums, take your knowledge up to a much higher level than where you're at, access to our private Discord chat with myself and all the 6, 7, 8-figure members, access to 1000xstocks.com, exclusive weekly videos from me, as well as being able to see the stocks I'm buying and selling in my public account, the Fidelity account.
7,300 on the S&P in the near term.
Yeah.
So are we witnessing this slow turnaround for stocks to get back on track? What do you think?
I think stocks took some hits. Partly was the software downturn and then this rotation out of the Mag 7 armies into the bullet makers for AI, and a general sort of risk off as gold surged. But the earnings have been delivered solidly. We've been getting good economic reports, and I think positioning has gotten risk off enough that we can sort of climb maybe in a labored way towards 7,300.
Hey, how about that? Do you think, we talked about this at halftime today, are we appreciating enough how strong earnings season has been?
I think the stocks haven't reflected that because we've had a huge beat, a large percentage of companies beating. It has shown up, I guess, in small caps, but to me...
Yeah, but I mean, you know what I mean? It's like, if you said we were going to do double-digit earnings growth, and that would be a key pillar of the narrative as to why stocks were going to continue to go higher, and then we had all this volatile chop, and, we're not sure now where we're going... You just said, well, if we're going to do that kind of earnings growth, we're going to be just fine.
Yeah.
I mean, hold your horses for just a moment. Listen, we're coming off of 3 banger years, back to back to back, banger years in the market, right? So to have chop in the market, that's very natural. After 3 banger years like this shouldn't be shocking to anybody, just to be honest. That's what you get many times, regardless of what the earnings are like. Earnings can be a banger, and guess what? You're still going to get this sort of chop in the market. It's just what happens after you have 3 great years. And that's why it's hard to put together 4 great years. It's possible, and it has happened, but it's very difficult. There's only a few time periods I can look back at in the last 50, 60 years. We had 4 great years back to back to back. It's very rare.
I mean, there's this old adage that it takes a whole lot of E to offset PE, meaning you're right, the earnings have been good, but things that have affected multiples are what's causing the market to come in. The AI, a new Fed chair, potential war. So you're right. I think the fundamental anchoring is actually good. So that means stocks eventually kind of re-anchor to that and we go higher.
So you say there are 3 key trades: rotation back to the Mag 7, the IGV bottoms, that's software, and crypto bottoms. But you're not suggesting that those 3 items have happened, are you?
Not yet, but we're maybe 90% of the way through that because I've seen some of the positioning data. So we know on for instance, prime brokerage, Goldman data, software ownership is multi-decade lows. And then we know that the Mag 7 have gotten cheaper than the bullet makers, which has never happened in 10 years. They're 3 PE points discount. And then, of course, on the crypto side, we've already gotten to drawdowns that are basically 80% of what's been in past crypto winters. So I think those are setting up to be really big trades. Maybe they've led the market. So they bottom first and they'll start to rally even if the market's peaking.
Does Nvidia earnings 1 week from today hold the key to the whole thing? Just given the fears about AI and the spend. And we need to get the results. We need to hear from Jensen Huang.
I mean, that could set the bottom because, if you look at the software index, this is the 8th week of a pretty severe downturn. So next week, as you know, sometimes 9 is a big number, turning point. That could mark the bottom for software.
Okay, so what? Listen, Nvidia numbers are going to be great. They're going to beat. Everybody knows it. How do we know it? Because 1, that's what Nvidia does quarter in, quarter out. How do we know it? Because have you seen the CapEx numbers? Where do you think a far majority of that money is going? Straight into Nvidia's pockets. This isn't rocket science. The guidance is going to be great. Numbers are going to be great. So if the market gets super excited about Nvidia, it's possible, but it's just silly. It's Nvidia numbers are going to be great. Guidance is going to be great. Conference call is going to be great. Jensen's going to be talking about we're all going to sell 1 trillion gazillion chips. What are we talking about here? Come on, man. Crypto. Listen, Bitcoin, Ethereum, that price action is not good, right? And these are assets that are driven off price action, and their price action's bad. They just aren't showing any signs of life. And that's with the market being near all-time highs right now. And you just have to think, gosh, if the market got hit 5-10%, where does Bitcoin and Ethereum go? Remember the Bitcoin cycle, I've been talking about this. It's supposed to, we'll see what happens, but it's supposed to not bottom until the 4th quarter of this year at around 30,000. So the Bitcoin cycle is accurate. There's a long way to go. Bitcoin's going to go down another 50+% if that's accurate. And Ethereum probably goes to $800. I think Tom Lee's losses are big right now. Just get ready. They ain't nothing yet, right? But we'll see. That's if that Bitcoin cycle's accurate, which we'll see. Home builder sentiment drops in February. Housing affordability remains an ongoing challenge. Okay, so Mohammed El-Erian expect a lot of volatility as we go forward.
Maybe the back half of the year?
Yeah, I think we will see it going back towards 4.5. And when we get closer to that, you'll hear something from the administration that will be very worried about the mortgage issue in the context of the affordability issue. You'll hear more about some form of yield curve control. So I think we are in a range from 4 to 450, with the average being closer to 450 than it is to 4.
Mohammed, if you were a PM right now, and you look at some of these software stocks that have just gotten absolutely crushed, and multiples now are half what they once were. I don't know. I'm just curious how you view it. I know you're not a PM, but you certainly talk to plenty of people who are still investing. What are your thoughts about that? Whether there is that opportunity or whether you have to really tread carefully?
So I would say we're in a different market. We no longer have the love affair with AI that we had last year. This is a market David defined, I think, and will continue to be defined by 3 words: volatility, dispersion. You're going to see a lot more dispersion, and fragmentation. And I would build my position bottom up, not top down, and I would certainly be picking up names that were impacted by this theory of the market for lemons, meaning they overshoot on the way down because they end up having a one technical correlation with names that are weaker. So I think this is a massive opportunity for stock picks, and particularly in the AI world and in the world impacted by AI. So for me, this is a world in which people should be building.
A new stock I'm looking at is Palo Alto Networks. Palo Alto Networks, that stock, I think it went down to 150 today. I believe I could fly. Let's take a look here. Palo Alto Networks. Let's get SanDisk out of here, and let's get the S&P 500 out of here. Yeah, 152 Palo Alto Networks here today. So it's been a great stock over time, like 5 years up 130%. But there's no doubt the stock's been getting hit heavy, but that's along with IGV and all the software stocks, right? On a 1 year basis, it's now quite negative, about 27% down now at this point in time, and year to date down 15%. So, but anyways, that's a cybersecurity company that almost every big company uses, and it doesn't seem like they're going to be replaced. So that's actually a very interesting stock, Palo Alto Networks.
Their portfolio bottom up and picking up some really good bargains at this point. It doesn't mean you buy the sectors across the board. It means you buy those with strong balance sheets, strong business models, and strong leadership.
And just lastly, Mohammed, on the volatility that you're foreseeing for the rest of this year, is that purely tied to AI as the market sort of bifurcates between the winners and losers, or does it also tie to geopolitics with U.S. and Iran trying to focus on these second round of talks?
Yeah, I mean, it ties to both, and geoeconomics rather than geopolitics, meaning that increasingly economic outcomes and policies and market outcomes will be less a function of economic and commercial logic and more a function of national security, geopolitics, and domestic politics. We no longer have the unifying theme. I grew up in an easy world where there were 2 themes: globalization, the ever closer integration of countries, and the Washington Consensus, certain ways you run your economy. We don't have those anymore. So we will get a lot of volatility as we go forward.
Yeah, Europeans clearly trying to wrestle with that as well, given
a lot of volatility going forward. So first off, what did I tell you on Inauguration Day? We're in the Trump stock market. It's going to be volatile. Get used to it, right? Market in general can be volatile, but especially, in a Trump stock market is going to be volatile. And if you went through term one, you saw some volatility. And like I told you guys, there's going to be certain time periods where you're like, trying to figure out how many Lamborghinis you're going to buy. And the next minute you're going to be figuring out if you can even afford McDonald's. It's just, that's the sort of stock market we're in. That's the sort of stock market we're going to remain in. And there's going to be big ups. There's going to be big downs. There's going to be time periods when your portfolio is exploding to the upside and breaking new all-time high. And you look and you're like, oh my gosh, made another 3,000 a day, another 5,000, another 10,000. Oh my gosh, this is so easy. This is the best thing ever. And this could be other time periods like, dude, am I ever going to hit a new all-time high again? I'm so far from it. That's just how it is. So, you don't get frustrated with it. Remain focused on the long term, buying great long-term companies and all that good stuff. Don't, focus on income, expenses. Make sure you got more income than expenses. Invest wisely in great companies. Do your research. Control what you can control. The market will be what the market's going to be. Alrighty, Mike Wilson.
Of a new bull market and earnings cycle, especially for many of the lagging areas of the index. That was your call in mid-November. Is that a call you still stick to?
Yeah, well, good afternoon. First of all, I would say yes. I mean, the story we actually started writing about in May of last year, which was our mid-year update, was exactly that. I think our view still remains out of consensus around this idea that Liberation Day marked the end of what we call a rolling recession. So we're actually not only in a new earnings cycle, we're in a new economic cycle. And that's why we're seeing the broadening out now, because there have been many parts of the economy that have been sort of mired in a recession for the last 3 years or so, and they're just now starting to emerge. Areas like consumer goods, some of the financial sector, industrials, obviously, which is getting a boost from AI CapEx, but also getting a boost from, basically underspending for the last several years. Parts of technology are still doing quite well. And
this is why a stock like Cake, to bring it back to Cake, if Cake's down, let's say 5% or less, or even goes green tomorrow, don't be shocked by that. And the reason you don't want to be shocked by that is people are going to look at a stock like Cake and be like, at the end of the day, the numbers are likely going to get a lot better over the next year and over the next several years. And so, yeah, it wasn't the most exciting year last year, but 2026 is going to be a lot better. 2027 is going to be a lot better. We're going to be in a strengthening economy. That's a view, right? No, that could be wrong, but at the end of the day, you look at the market's saying the economy is going to get better over the next few years. And that's why you're seeing this broadening into a lot of these stocks. You're seeing momentum. And the big tech's not rolling because those are the type of companies that are supposed to do good regardless of the economy. Those companies have done just fine even with a weaker economy the last few years. But if you believe we're in a new economic cycle that's strengthening, then it's hard to be bearish on restaurants, right? It's hard to be bearish on travel. It's hard to be bearish on hotels and consumer goods, right? All that sort of stuff. So just something to keep in mind there.
Running out is the real story, and we doubled down on that in November because the evidence was coming through. And in May we didn't know, but now we know. I mean, the earnings growth for the median stock in the Russell 3000 is now running double-digit growth year over year. That's the first time we've seen that in 4 years. So it's happening.
You don't want to get in the way of stocks like Nike, stocks like Estee Lauder, those sorts of stocks. If we got a strengthening economy, even stocks like Wynn Resorts, don't get in their way. If you got an improving economy over the next few years, don't get in those stocks' way. Oh boy.
The question now is, how long can it last? What could derail that? And what do you pay for? I mean, those are always the questions. But the first part of your question is a resounding yes. We are in a new earnings and economic cycle, and the market has figured that out.
Hey, Mike, it's been pretty remarkable to see that we've gotten this tremendous stock volatility at the single stock level, also at the sector level. But when you look at the S&P 500, it actually hasn't really done much this year. What is it going to take to break us out of this range? And what could be the catalyst to get us past that elusive 7,000 level that everyone's waiting for?
Yeah, that seems to be the question. I mean, obviously, stock investors don't. I mean, if you can make money in other areas, that's fine. I think that's the real main message, is that the market is not going anywhere at the S&P level, but there are many sectors that are doing well, and that's the name of the game. Now, to your question, I think what's going to break us out ultimately are two things. Number one, there is some uncertainty around the AI CapEx cycle and the disruption that perhaps it could cause in the labor market and other areas. So I think we're in one of those testing periods now. We wrote about that this week. We think that ultimately it's a little bit premature to kind of throw a cold blanket on the AI cycle. It's just getting going, from our standpoint. And then secondarily, I think we have a new Fed chair nominee with Kevin Warsh. And the market always tests the new Fed chair, whoever it is, when they come into power or office. And so first we have to go through the confirmation hearings, and then we got to learn a little bit more about what he really intends to do. So that could lead to this, the market kind of struggling for another month or two. And then ultimately we think once he takes office, we think that'll be another catalyst for why the market can have a really good second half. And we stand by our $7,800 price target for the S&P by the end of this year.
So there's two main things that could break this market out. One is a scenario where you see economic strength in the numbers, but CPI continues to go lower, which means, you got to have strengthening economy with inflation being dead. That would be the ultimate best thing, because then the Fed could be able to cut, maybe more times than people expect into a strengthening economy. That could be seen as a very good thing. The other thing that I think is even more realistic, though, if you want to think about something that could break us out, is next quarter when companies report, which they're still, big dog companies are still a little over 2 months away from reporting their next earnings. I'm talking Meta, I'm talking Amazon, those sorts of companies. Show a major acceleration in revenue growth. Show us that the CapEx is being well spent. If Meta comes in with like a 37% revenue growth number, if AWS accelerates growth to high 20s, maybe like 30% number, okay. Big tech starts moving again. People will be like, you know what? Okay, they're spending a lot, but look at the revenue growth. It's so ridiculous. Right now, the revenue growth is good for these companies, maybe even really good, but it's not like, oh my gosh. Have AWS push close to 30% growth with how big that business is. Have Meta come in with like a 35% revenue growth number or 37%, and watch the momentum start to come back into those stocks, because then people will be like, okay, they're spending a fortune, but look at the revenue growth. It's ridiculous. So, they're spending wisely, right? Once again, my private stock group, if you're looking to apply to join us in there, that will be the pinned comment down there today. That is a group mainly for individuals with $100,000 plus net worth. You can still apply if you have under 100K net worth. It just might not be a good fit for us. We'll see, okay? Look at silver, ladies and gentlemen, is now down for the year. That's absolutely fascinating, because silver was the main subject, it seemed like, of just a few weeks ago, and now silver is down 40% from those highs of a few weeks ago. Look at this. This is IGV. This is the basically like the software ETF, and it has died of death now at this point in time. Look at this. I mean, keep in mind, folks, we're a month and a half into the year, and it's down 24%. Absolutely dead. Those stocks continue to get obliterated. Look at Intuit stock. Intuit, literally, you just go back 6-12 months ago, everybody would call Intuit one of the best business models in the world, right? And look at this stock, is down 42.5% year to date. Absolutely nasty. Salesforce down over 30% year to date. Once again, this is another one. You go back 12, 18 months ago, people would call this one of the greatest business models in the world, and these stocks are just being sold relentlessly right now, right? Can't catch a break for that stock. Look at Adobe. This stock is down 25+% year to date. It's getting hard, I will say, with Adobe. It's starting to get hard to push the stock down. The forward P is down to like 11 or 10 now at this point in time. So that one's getting tough to push down. ServiceNow got some great news today, and it still didn't end up mattering. The stock ended up red after it was very green early in the morning, essentially. That stock's down well over 30% so far this year. And once again, we're a month and a half into the year. Unbelievable. Mag 7 stocks suck in 2026. Look at this. Every single stock is Red Dead Redemption this year. Every single one. I mean, unbelievable. Nvidia's down, Meta's down, Apple's down. I was kind of shocked Apple's down, because I thought like Apple was having a good year, and then I looked and I was like, oh no, Apple's actually red for the year? That's crazy. Google McDougal's down, Tesla's down, Amazon's down big, and Mr. Softy Microsoft is the worst of them all with a 16+% downward move here in 2026. Look at this. This shows you a heat map of the S&P 500, and man, there's a lot of great green pockets out there. Walmart, Costco, Coca-Cola, Pepsi, Procter & Gamble, Gamble, Home Depot, Caterpillar, John Deere. Like, you go through a lot of these companies, a lot of the energy stocks, very nicely green, but man, a lot of these Mag 7 type stocks, just not the place. Meanwhile, you look at a stock like this. I posted this on my X page here today. If you ever want to follow me on X, I always have it linked in the description area down there. I said this boring restaurant stock has outperformed 90+% of tech stocks the past few years. And it's fascinating, right? Like, Cake has basically 2x'd my money from my initial buys, just back in kind of like mid 2023. Fascinating. A stock like that performing tremendous, up almost $70,000, and it doesn't account for dividends received in that stock. Since I started buying Cake's basically doubled, right? Meanwhile, IGV, that software ETF, is up 36%, and Mr. Softy's up 28%. Shows you, if you get in the right positions, it can, change things dramatically, and especially in regards to the timing you get in. Look at a stock like Elf's up almost 12% this year. It's been a very volatile year for the stock, but at the end of the day, it's been a good year so far. Like, you can make 12% in a month and a half, you'll gladly take that. Nike's green for the year, we'll take it. Estee Lauder, this stock's up over 5% year to date. Boring stocks, man, they're winning. Mag 7, it's got all the talk and all the hype the last several years, tech stocks in general, but those stocks are just not the play right now, and it's these boring companies that no one's wanted the past 3 years that all of a sudden we're seeing a flood of money come into them, right? Look at this. This is my hedge against Tesla stock. This is 2x leverage against Tesla. It's up over 18% this year. Talk about a phenomenal hedge, right? 4 core subjects I want to get into in this video here today. 1, are Micron, MU, and SanDisk tricks or treats? Are those stocks? Those have been 2 of the hottest stocks in the stock market the past year, even year to date. Are they a great buy, or is this a trick situation? We'll talk about that at the top of this video. Second, I want to talk about the ultimate long-term stock to buy, essentially, okay? The stock that is got the next 10 years set up so phenomenal for them. We'll talk about that in this video and what stock that is. Third subject up here, we'll talk about 3 non-tech stocks that I love right now. Well, 4th subject, SaaSpocalypse. It's going on. I'm going to rank in this video my top 5 SaaS stocks in this video here today. Talk about a freaking banger. Is this a banger or is this a banger, baby? Okay, this is a banger of a video. One thing all I need from you guys, if you haven't already done so, just hit that little thumbs up button, smash that little like button for me. I hope you can do that. I've been prepping this video for hours and hours and hours for you guys here today, and all I need is a little smashing in return, okay? Appreciate you for being here. Make sure you're subscribed. Make sure you got notifications on, all that good stuff, okay? Listen. This is a 1-year chart of SanDisk and Micron versus SP 500. SP 500 up 11%, MU stocks up 274%, and SanDisk up a shocking 1,150%. Unbelievable. Memory for the win, right? So look at a stock like MU here, okay? MU right around $400 here today. Look at the trailing 12-month trend of revenue. Clearly it's up and to the right, but look what's about to happen to the revenue. It's gonna go to the moon. So when you see a stock like MU and you see the stock up so dramatically, right? Almost 300% over the past year, understand it's not for no reason. It's because their business is blowing up in a great way right now, right? What they're able to command for pricing of memory is going through the roof. And memory in general, demand for memory in general is going through the roof. You got to understand, all this AI is using unbelievable amounts of memory, okay? And so this isn't going to stop. Like, this is unbelievable amounts of memory that need to be used over the next several years. When you see Nvidia making all this money over the next few years, when you see AMD making all this money over the next few years, just understand this doesn't happen without memory. It's a core need in these products, essentially. Look at the trend of net margins and gross margins for Micron. And this isn't over. It's going to go much higher before it goes lower. I can tell you that in regards to net margins and gross margins. This trend will continue for quite some time here, okay? Additionally, this shows you, we're looking at 1000xstocks.com, by the way, here. Check out the trailing 12-month earnings per share. This is where we're at right now. It's an insane increase over the last several quarters, but it's nothing, literally nothing compared to where these earnings per share is going over the next 12 months, essentially. It's going to be like a night and day difference for MU overall, right? Operating cash flow, this is where we're at right now for operating cash flow for Micron. Imagine where this number is a year from now. with the demand that Micron has, with the pricing they're able to command, oh my gosh. And here, ladies and gentlemen of the jury, here is the most amazing thing about all this. I just showed you demand for memory is going insane, pricing's going insane, the revenue is going insane, net margins are exploding higher, gross margins are exploding higher, earnings per share is exploding higher. It looks like the perfect scenario and the perfect stock, and none of this AI wave happens without memory, right? And keep in mind, there's only a few major memory companies in the world, right? But the best part of this whole story is this. The forward PE on Micron is under 10. You look at that and you're like, dude, how is that even possible? This company's business is going insane. The numbers they're going to put up for the next several years are going to be ridiculous. How is this company trading at a forward PE of 10? You would think it'd be 30, 50, 70, 90 forward PE, like way higher number than 10, right? Well, here's the deal. Okay, so we know their earnings per share is going to go insane this year. We know it's going to take another leg higher in 27, right? And we know it's probably even going to go up in 28. But here's the issue. We have a major moderation that likely comes in 2028. Could come in 2027, but I think 2027 will still be a nice increase. It's going to be way less of an increase in 26. Keep that in mind. But things are going to start to moderate definitely in 2028, in my opinion. So then you're going to ask yourself, what happens after that? Well, here's what happens to memory chip companies. They go through busts and boom cycles. A bust, and then a boom, and then a boom, and then a bust. And it's over and over and over and over again. I'm showing you right now the earnings per share on a quarterly basis of Micron over the years, okay? This is dating all the way back to kind of like 2011. So we can go back. Basically, it's like a 15-year chart, right? So MU right here is going through a complete bust cycle in regards to memory demand. Then they go through a boom cycle. Then they go through a bust cycle. Then they go through an insane boom cycle. And guess what happens right after that? A big bust cycle. And then right after that, guess what happens? A big boom cycle. Followed by, guess what? A massive bust cycle. Followed by, guess what? What we're in right now is a massive boom cycle. Not only are we in a boom cycle, this is the biggest boom cycle Micron's going to have ever seen in their business model's history by a mile, right? And that's also why the stock's way higher than we've ever seen it before, right? So we're in a boom cycle. We're going to be in this boom cycle, and these numbers are going to be insane for the next couple of years, right? What do you think's happening after that? I'm going to go out there on a limb, and I'm going to say a few years from now, there's going to be a massive bust cycle. Ladies and gentlemen, that is why people don't want to pay up for Micron stock. That is why it trades at a forward P of 10. Because everybody's understanding, yeah, this company's going to have an unbelievable year this year, an unbelievable year next year. And then things start to moderate in 28, and guess what happens after that likely? Major bust cycle. And the bust could be even bigger than previous busts because this boom cycle is way bigger and way more dramatic than anything we've seen before, right? So that's something to keep in mind. Now, some people will say, okay, and I'm sure these memory chip companies will make an argument like, we're not going to go through another bust cycle. No way. Never going to happen. The business models have changed forever. It's only up and to the right, right? I call BS on that. I don't believe that. I don't believe that for a second. This is the same industry that it's been, and AI demand's going to always be there, right? Demand for memory is going to continue to be there, but that doesn't mean you don't go through bust cycles. If I showed you the past 15 years of demand for memory, guess what it is? Up and to the right. It's like, I don't care what you use. I don't care if you're talking computers. I don't care if you're talking cell phones. I don't care if you're talking gaming consoles. I don't care if you're talking a refrigerator. Everything seems like it uses memory nowadays, and way more memory than we've ever seen at any point in history. And yet, despite the need for memory just going up and up and up, look at Micron over the years. Massive boom and bust cycles, again and again and again. And so that argument around like, well, the demand for memory for the next 10 years, 20 years is just going to go higher because of AI and because electronics and all this stuff, Doesn't mean you're still not going through a bust cycle. It's been going higher for 30, 40, 50 years, forever now at this point in time. And yet you still go through these boom and bust cycles. So that's what's important to keep in mind in regards to the subject, right? The other kind of risk in regards to specifically Micron is they have abandoned their consumer business now at this point in time. And they're basically kind of betting the farm on, these big customers, the AI companies and things like that, right? And so Samsung, SK Hynix believe holding onto the consumer market gives them a pressure valve if AI demand ever slows down in 2028. They still have millions of gamers and laptop makers to sell to. Micron will have nowhere else to go. So that's something just to kind of keep in mind in regards to Micron specific. So what Micron looks like to me and what SanDisk looks like to me, okay? They don't look like huge bubbles. No. People say, oh, those are huge bubbles because the stocks went up a lot. They're not huge bubbles. I'll tell you exactly what they are. They're value traps. Value trap is a stock that is a great company, very well known. They have a needs-based product a lot of times, right? And they're able to produce unbelievable cash flows, unbelievable profits. But at the end of the day, the stock does nothing because it's going to go through troubles in the future. And so people are not willing to pay up for it. And so you see it trading cheap and you're like, this is the greatest deal ever. Look at the company's growth. Look at the company's P ratio. This is magnificent. I've just found the most perfect stock in the world, right? And what you end up getting into is a major value trap. And a good example of that I've got into over the past few years, it's been a huge value trap. Perfect example. I'll give you a stock. You know what it is? PayPal, otherwise known as PayPal. PayPal's been a huge value trap the last several years. And as somebody that's been an investor of that company, 100%. Look at their revenues. They've been up and to the right. Look at their profitability, right? And at the end of the day, and look at how low their PE is. Does it mean anything for the stock price? No, it's been a huge value trap. Right? People don't want to pay up for that company because they look at it and they're like, really low growth rates, right? And so Micron's going through this time period when they're in a boom. They're going to be in a boom for the next 2-3 years, and then it's coming the bust, right? And people just don't want to, bid up a stock dramatically more that's gonna have a bust cycle, we can call it a few years from now, essentially. No, some people might say, oh, I want to buy put options on a stock like this. Not smart, highly risky. Not on Micron. Listen, you got a company here that's going to make bank for at least the next 2 years. 2026 and 2027 are going to be unbelievable years for Micron. You don't want to step in front of that. No way. And with the forward P at 10? Nah, I'm good. That's not a smart bet. You might be able to get lucky and maybe buy a put option, and the stock goes down short term or something like that. But I'm just like, there's way better opportunities than that. You usually, if you're going to come in and bet against a stock, you want to bet against a stock that, doesn't have earnings, right? Or is in a situation where the valuation is just trading insane. Micron's got earnings for days. Oh my gosh, they got plenty of earnings. They got no shortage of earnings for that company over the next few years, right? And the P's dirt cheap. So to buy put options against that stock, it's just not a smart decision, man. Not a smart decision. And just because the stocks went up a lot is not a reason to bet against it. There might be a time period when it makes sense to bet against Micron, but I wouldn't do it right now. Oh, heck no. You get out of the way. That's a freight train right now, right? No, at the end of the day, Micron stock, in my opinion, where's the stock price going over the next few years? It's going to be stuck. I think it's going to be a stuck stock for the next few years. I think it's going to be stuck between $300 and $500 a share. People feeling bullish, they'll bid it up to 500-ish. And they're feeling bearish, they'll bid it down to, or send it down to 300 range, right? And I think that's just where it's going to be for years to go in the future. And so anybody betting that, the stock's going to crash in the next few years here down to 150, I don't think that's very realistic. And people thinking, this stock's going to 1,000 over the next few years, I don't think that's realistic either. I think this is a stock that will just be stuck for years. That's my personal opinion. I could be wrong on that. But don't be surprised if year by year goes by and it's like, oh, there's Micron still in that 300 to 500-ish range, right? So we'll see, but that's what I foresee in regards to that matter, okay? Alrighty, next up here, the ultimate long-term stock to buy. Then we'll get into 3 non-tech stocks that I love right now. In the SaaS apocalypse, I'll rank my top 5 stocks in order that are the best buys in regards to that. Before we get into that, pinned comment down there today, if you're looking to apply to our private group, that is access to all of my course curriculums. There's really 3 components you get when you join us in the private group. It's an exclusive group, by the way, of 3,000 members. But you get the education component of all of my best courses: Become a Master Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, Jeremy's Valuation Mastery. That's component number 1. The second component is our Discord chat and our community, which has 3,000 members in it. Many of those members have multi-6 figures in their portfolio, 7-figure, 8-figure investors, okay? And the third component you get when you get access to the private group is you get access to my advanced software, 1000xstocks.com, which I use on a daily basis to run my projections on companies and where these stocks are going over time, look into them, do research, all that good stuff, okay? You also get other features like being able to see the moves I'm making each week and exclusive weekly videos, all that good stuff as well. But those are 3 main components: the education, the community, and the advanced software. Okay, that will be pinned comment down there. Click on that, fill the form. We'll see if we can get you access in there either this week or next week. Okay, the ultimate stock to buy long term. Listen, it's Amazon without question. This is a stock, okay, that just understand with Amazon, don't get super bowled up about the stock in the short term, okay? They're spending like insane right now. That depreciation is going to hit over the next few years. There's going to be questions about AWS and if they're really spending on, so much that it's really going to help AWS growth rates and those sorts of things, right? But I back this up, okay? Amazon's a stock that has returned 164,000% long term. It's unbelievable, right? But throughout this time of 30 years or whatever since the company went public, right? There's been plenty of time periods when the stock went down significantly or didn't do anything for quite some time, right? This could happen for months. It could happen for years, right? Where the stock would go down and would go nowhere. It'd be no man's land. And right now we're kind of in one of those time periods when the stock's just in no man's land, right? And there's usually 2 reasons why all of these situations happen. One is they had to go through a major investment period and Wall Street kind of pushed back against that. Investors pushed back against that. And they're like, oh my gosh, Amazon's about to invest so much money. It's a holdback of the company, right? And the second reason is if growth rates were slower than people thought they were going to be, right? And part of that was kind of in the tech bubble blow up there. You could say valuation as well, but definitely growth rates weren't as epic as some people had thought they would be. Even in the great financial crisis, that happened as well, right? And so those are kind of the 2 main things that can happen and can push Amazon stock down or just make it flat for quite some time, right? Now, if Amazon's not spending all this money for no reason, right? Just think about this for a moment. Amazon says they're going to go out and spend $200 billion this year on CapEx. Right? Much of that's really for their AWS business. They're not doing that just to do that. Okay? They're doing that likely because they believe this can accelerate AWS growth significantly, and AWS can be set up for the next decade, if not the next 2 decades, right, of major growth. Now, what we're seeing right now is AWS growth is accelerating, okay? I think we pushed this last quarter, don't quote me on this, but I think we're pushing to like around a mid 20%, low to mid 20% growth rate in AWS. AWS should continue to accelerate growth for a bit here, okay? So I think the reason Amazon's spending so much money, okay, is I believe they think they can probably grow that business at like a 20% CAGR for the next decade. Now, that might not happen, but let's say hypothetically they do. Let's say they are able to achieve a 20% compounded annual growth rate on that AWS business over the next decade, essentially, okay? Well, guess what? They're going to have around $1 trillion a year business if they're able to do that, okay? Around $1 trillion a year. Now, let's say that's not achievable. Let's say instead of that, let's say maybe, the next few years with this AI wave are really high growth rates. Let's say they're growing at like a 30% clip mid-20s. That's very achievable over the next few years, right? Mid-20s to maybe into the 30s when it comes to their percentage growth. But then let's say after this whole big AI wave, let's say growth rates slow and they start going into like the 10, 12, 15% range. And so let's say they achieve like a 15% CAGR over the years. This company still ends up reaching in 2035 a $500 billion plus a year business, okay? 2036, so a decade from now, we're talking about a $600 billion a year business. A year business, okay? Which is incredible. And I think that's very achievable. So the way I would look at this is I believe Amazon, this is my thought, I believe Amazon thinks they're going to be able to grow AWS business to a $600 billion to $1 trillion a year business over the next decade. That's my belief on what they're doing and why they're spending so aggressively. And it all starts to make sense why they're going to do that, because the profits on AWS are pretty phenomenal, right? Now, keep in mind, they're not the only ones spending. Microsoft's spending heavily here. Google's spending heavily is here as well. I believe all these companies think they're going to grow their businesses very nicely. And honestly, the growth rates are very impressive. Azure, which is Microsoft's product, last quarter, I believe that grew around 38%. Or somewhere around there. Google's cloud business is booming right now. I mean, absolutely booming right now. So there's plenty of money to go around in this space over the next several years for these companies, right? Now, the profit factor when it comes to AWS. AWS operating margins are around 35%. Keep in mind, that could go up, could go down if the competitive environment gets tougher. But let's say they are able to keep that number, right? In that 20% scenario I ran you through, in 2036, the company would be throwing off $330 billion in annual operating profit just from the AWS side of the business. Oh my gosh. So in a more conservative scenario, you could say maybe the company's throwing off $200 billion or $250 billion a year in operating profit just from AWS. We're not talking the advertising business. We're not talking the e-commerce business. We're not talking about any other future businesses they start or any other future businesses they acquire. We're just talking AWS right now, right? Now you start to say, okay, shoot, now I see why they're spending so much, right? You can start throwing off $200, $300 billion a year in operating profit just from that business unit. That's big money. Now you're talking about you're getting a great payback. I mean, you could be talking about you're getting the $200 billion you're spending this year. You get that back in months, not even a full year down the road. That's incredible. Now, if we think about where the valuation of Amazon's going long term, right? So, they got their AWS business, which is the big dog, right? Advertising business, we should, that's been growing very nicely. That should continue to blow up over the next, decade. The retail business and subscriptions should continue to boom as people order more and stuff. Like, basically, the way I would look at Amazon is this is a company that should be bringing in $2 to $3 billion a year in revenue 10 years from now, okay? They're going to cross likely $1 billion in revenue. $1 trillion in revenue. They're going to cross $1 trillion. It's $1 trillion a year, by the way. They're going to cross $1 trillion of revenue likely in 2 to 3 years from now, in terms of they're doing $1 trillion plus in revenue a year. So in 10 years, they should be able to do $2 to $3 trillion per year in revenue. Okay. Of that, I think they'll be able to throw off about $500 billion roughly. Maybe it's $400 billion, maybe it's $500 billion, maybe it's $600 billion or $700 billion, right? But I think roughly $500 billion a year in net income, which, you could easily say a 20p is fair for a company like Amazon. They'll still be growing at that point in time, right? And you're at a $10 trillion plus market cap a decade from now, right? Now, AI did their own valuation here, and they got to a $10 trillion plus company. That's where I believe Amazon's going over the next decade. We're going to a $10 trillion plus company here, right? And I know these numbers sound big because we have no $10 trillion company now. What's the biggest company in the world? I believe it's Nvidia. And I believe Nvidia is a $4 trillion something company right now. So to say 10 trillion, it sounds big. Dude, when I got in the stock market, we couldn't even imagine a $1 trillion company. Now we got a bunch of $1 trillion companies. Now we got a bunch of multi-$1 trillion companies. When I first got in the market, 08, 09, shoot, I remember seeing companies like, Procter & Gamble and ExxonMobil, at $200 billion, $300 billion market caps. These were the biggest market caps in the world. It was crazy. I remember getting hired at Quick Trip in 2010, and I remember looking at Apple stock. And, Apple stock at that time, gosh, I can't remember what the valuation was. I think it was like 500 billion or some crazy number, 600 billion. And it was like, oh my gosh, like they can't get any bigger than this. Like that's insane, right? And now Apple easily commands a $3 trillion plus valuation on it, right? So when we talk about a decade from now, $10 trillion market cap, just understand, I don't think Amazon will be the only $10 trillion company 10 years from now. They're probably going to be one of several companies that are $10 trillion plus market cap, right? So something to keep in mind there. I think Amazon's a perfect example of why I love stock picking and having a long-term mindset, right? I love being able to look into a company like Amazon and be able to run numbers, run projections, and try to find a company that I believe is a safer bet than the S&P 500, but that could likely outperform the S&P 500 significantly over the next decade, right? And I think that's a perfect example is Amazon, right? Also, having a long-term mindset. It's very easy to get caught up into the short term of, people are spending a lot of money right now, and that's going to hit the depreciation. All those things matter in the short term, right? They all do. And what's going to happen with tariffs, and what's Trump up to, and what's the Fed up to, and blah, 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 right? And what's the economy doing in the short term? Like all these things, they all matter, but they're all short-term things. They come and they go. And companies like Amazon remain. When Amazon was founded, Bill Clinton was the president of the United States. Okay? Bill Clinton. And then it was George Bush. And then it was Obama, and then it was Trump, and then it was Biden, and then it was Trump, right? And so all these presidents come and go, all these geopolitical things come and go, deflation, inflation comes and goes, right? Usually it's mostly inflation. Good economies, bad economies, okay economies come and go, right? Monetary policy changes come and go. Raising of interest rates, decreases of interest rates come and go. Fed presidents come and go. It all comes and goes. It's all just do. And yet Amazon remains and gets bigger, stronger, right? And that's the thing with great companies. And that's why it pays to really stay focused on the long term. Because there's just so many times you could have got caught up in the short term with Amazon, right? Oh, they're spending a lot. They're spending so much on this e-commerce infrastructure. And look at the e-commerce business loses the money. Why are they spending so much? Like there was a lot of debate and questions about that 10, 15 years ago, right? Oh my gosh, they're spending so much. Like they're building all these warehouses. They're getting all these trucks. They're going to do their own delivery networks. There's no way they're going to make money off this. They're only going to charge blah, 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 blah. You gotta put the trust in the big dogs that run these companies and they know what they do. And honestly, they got a pretty impressive track record, right? Doesn't mean they can't make mistakes and they will make mistakes, but doesn't mean they're perfect. But man, they do a pretty dang good job over time, right? Have a long-term mindset. Try to find great companies, right? Okay, next up here. 3 non-tech stocks I love. Okay, and then we'll get into my top 5 SaaS stocks. Well, number 1 is Cake. This is a stock I have loved for years. If you watch my channel religiously, the amount of times you probably heard me talk about Cake and feature it on 3 stocks I'm buying and 5 stocks I'm buying and all those sorts of videos is a lot, right? It's a great company. It's made me $70,000 of profit so far. That doesn't even include all the dividends it pays me out over time, right? And when it comes to cheesecake, they got the ATM machine, which is Cheesecake Factory, but then they have North Italia, which is expanding across the United States and will continue to over the next decade. And they have Flower Child that's expanding all over the United States over the next decade and will continue to, right? And they got a bunch of concepts behind those concepts that are next up, essentially. And so Cake's just a growth engine with a core business. They got a core business with Cheesecake Factory that's an absolute profit machine, right? And then they have all these growth concepts coming behind it. So it's like, I think it's one of the most perfect, I think it's the most perfect restaurant stock I've ever seen. I've never seen a restaurant stock that you could get an ATM machine for a core business model with a bunch of major growth concepts coming behind it. You've never seen that before. Like if you think about like Chipotle was, like a super expanding concept, but it wasn't like they had a core business that was like super profitable in those days, right? you could go through almost everybody. Like Texas Roadhouse was kind of a one-trick pony. It's not like they had a bunch of growth concepts coming behind them and things like that. Like, even though they technically do own a couple other concepts, but those are kind of like joke concepts compared to like a North Italian, a Flower Child. So you really go through it and it's just like, this is a very special company. This is a 101 in the restaurant space, like something we've never really seen before, right? And so here are my projections for Cake. This is my bull case for Cake. I have them doing 9% revenue growth on average per year over the next several years. Keep in mind, stuff's always getting more expensive. So basically, Cake can get 2 to 3% of revenue growth per year just based upon inflation, right? So that's something to kind of keep in mind there. So you're almost guaranteed to get 2 to 3% of growth from that. Then you get a few other percentage revenue growth from North Italia and Flower Child and the other concepts expanding. And then, as far as Cheesecake brand goes, you just got to do a little more volume, right? And you can see how you can get to a 7% or maybe even a 9% growth rate. For the bull case, I have a 9% growth rate here, right? Net income growth, 11%. I had them outstripping revenue when it comes to net income. And so, if you got a restaurant concept like Cake growing 9% top line, 11% bottom line, 28 to 33p is pretty fair, which gives me a CAGR easily in the mid 20s to high 20s here. Very attractive, right? This is my base case, just a fancy way of saying what I expect. 7% revenue growth on average for the next 4 years, 9% net income growth, right? 25 to 30p be fair for a company like Cake growing at those sorts of growth rates. And we're talking a low 20s CAGR here for Cake. This stock's on its way to 100 plus. And that's why I hold Cake. It's going to 100 plus, baby. Okay. And here's the other thing when it comes to Cake. Pays me a dividend every 3 months. Pays me 27 cents per every share I own. Right. And so that means I make $877 every 3 months paid out to my public account. Right. Which then I can go buy more Cake shares of or buy other stocks with. And then obviously I own Cake across portfolios, so they pay me a lot of dividend money all the time. And I take that dividend money and go buy other stocks with it. And it's beautiful, beautiful dealio in regards to Cake. So Cake is a very, very special stock. I think it's very underrated. I don't think, and keep in mind with the dividends, like they're probably not going to up their dividends much over the next few years because they need to spend that money really on North Italia expansion and Flower Child expansion. But just keep in mind, those are going to produce unbelievable profits, which then longer term, if they want to pay much fatter, bigger dividends, they can. Okay, so just keep that in mind. Number 2 or 3 is ELF. ELF's another great example of a stock that's non-tech related that I absolutely love. This is a stock that has performed tremendous for me over the years. It's a very volatile stock in the past couple of years. A lot of drama. There's a lot of moving parts. Like they bought several brands. Those brands are looking phenomenal, especially in regards to Rode. That's a game changer for the company. Growth rates were ridiculous at one point for them. Those growth rates slowed down. You had the tariff drama. You just had a lot of moving parts in regards to ELF here, okay? But at the end of the day, this is a great growth company that puts up their numbers. Based upon my projections for ELF, my bull case, I have this stock going to $238 to $272 in my bull case come 2029. For $80-something stock, it's pretty attractive. My base case, just a fancy way of saying what I actually expect, I have the stock going to $160 to $187 a share come 2029. That's tremendous upside from here, essentially, right? So ELF, absolutely a company I love. Boring stock, cosmetics. I'd like to make money. Making money to me is not boring. It just never gets boring. I'm amazed. I'm like, you think you get bored of making money. I just never get bored. It's just always fun, right? Next one up here, number 3 of 3, is this one, SoFi, non-tech related technically. Even though some people would say, well, it's kind of a fintech, and that's true. But SoFi is really the future of banking, and you really look at how many members they've attracted, the revenue trends, the margin trends, and those sorts of things. It's unbelievable. We're up 134% on the stock, up $56,000, which is a very small number compared to something like ELF, which is up over, we can call it around 1,100%, right? But SoFi has been a great stock for me. I think it's going to continue to be a great stock for years to go in the future. And the thing with Anthony Noto running the company is as long as he risk manages his company properly, which that man, he comes a long time ago from Goldman Sachs. You really learn about risk management at a company like Goldman Sachs, right? As long as he continues to run this company from a risk management standpoint, like the world is theirs. Like, the thing for Noto is he just got to not screw it up. It's as simple as that. You have a company here that's so good, it's like a racehorse. You just got to not screw it up, man. As long as you don't screw it up, like, the world is theirs. It's unbelievable. The growth rates this company has is unbelievable. So SoFi, the future of banking, as simple as that, right? I would think an honorable mention for a non-tech stock I love is Nike. Nike's an honorable mention here. The turnaround's clear as day now at this point in time for Nike. Elliot Hill's doing an amazing job. He actually had a really good interview recently with Bloomberg that I really liked. But yeah, Nike, it's definitely the turnaround. There's not a question about the turnaround anymore at this point in time. Like, you look at the North American numbers, they're great. The China numbers will likely start to turn as this year goes along and get better and better. So Nike, honorable mention. Okay. Next up here, we got a SaaS apocalypse going on for all these SaaS stocks. Let me give you my top 5 SaaS stocks ranked in order. Keep in mind, let me say this first, I am buying SaaS stocks very heavily in the first quarter. Something I telegraphed I would do, seeing the weakness, and I'm trying to get my hands on as many shares of some of these great SaaS stocks as I possibly can here in the first quarter. That does not mean I'm done buying them. I'm going to probably buy these stocks for the whole year. But the aggressive buys is really in this first quarter, because this is where a lot of the damage is occurring essentially. And so there's no doubt there's some SaaS stocks that are going to be replaced, right? There's some that are going to be irrelevant or have trouble growing their businesses and things like that. There'll be some that will be value traps, right? And you can make arguments that if you think these companies aren't going to really grow very much over the next several years, you can make an argument that many of these SaaS stocks will be value traps in the end. That's a fair debate that can be made there, right? But the future I see involves these companies growing at very strong single-digit or low double-digit growth rates over the coming years, and net income growing at even a faster clip, and earnings per share growing at even a faster clip, because they don't have to spend the way these hyperscalers are having to spend on their businesses, right? So they can do big share buybacks. Okay, so let's rank these, my top 5 here. Number 1, this is the best buy, in my opinion, in the SaaS space, and it is CRM. It is Salesforce. I think this is least risky of the bunch. We're looking at Salesforce now at a forward P of 14. Next year, earnings per share growth expected to be around 14%. Next year, revenue growth expected to be around 9%. I mean, geez, I expect Salesforce to come in and beat numbers throughout the year. They have a full suite of products that they sell to their customers, people are running these insane conclusions that, everything in software is going to be just replaced and, sent out of these companies and you don't need these companies anymore and things like that. I think that's a far-fetched fairy tale is what I would say in regards to this matter. So Salesforce, I love that company. Benioff, do you want to bet against Benioff? Come on now. You don't think Benioff's going to make, people are only viewing it from the negative angle here when it comes to these SaaS companies, and for somebody like Salesforce and all these others, right? They're only viewing it from the negative angle of AI wave is only going to be negative for these companies. It's going to hurt their growth rates. It's going to hurt their margin opportunities over the years. It's going to hurt everything, right? It's going to make them irrelevant. And the way I see it is very different. And Jensen's talked about this as well. I see this as being a great accelerator for the next wave of growth for a lot of these software companies. And I look at something like Agentforce and what they're doing there and what they're going to do with other products in the AI space. And I think, if anything, this is a huge opportunity for these companies. And these companies have definitely had much slower growth rates the last year or two. And I think, if anything, this AI wave is not going to decrease growth. I think it's going to increase growth. I think we're going to see growth accelerations, even from companies like Salesforce. Number 2 of 5 is ServiceNow. This one's next up here. So McDermott running this company, 25 forward P on this one. So this one seems a little higher in regards to forward P, but this one's got way better growth than really almost anything in this space, right? Next year, earnings per share growth expected to be about 19% for ServiceNow. Next year, revenue growth expected to be 17% for ServiceNow. Don't be surprised if they beat those numbers. Don't be surprised if next year they come in with earnings per share growth that is in the 20% plus range and revenues that are around 20% roughly, or 19%. So ServiceNow, I like that one a lot. And that one's so embedded into these big companies. Oh my gosh. Yeah. Next one up here is ADBE. This is the one I think people could make the strongest argument that it's a value trap, right? And that you're not going to make money and it's a PayPal type situation. I think that's fair, but I just don't see it like that. I don't think people understand how Adobe makes most of it. Adobe makes most of the money from big companies, from their marketing departments and creation and all those sorts of things, right? And so Adobe is still necessary for doing all these high-end things that you want to do with images and photos and for marketing and all that sort of stuff. And so when you're in the Adobe ecosystem, you could get out, but a lot of times it just doesn't make sense. It does not make sense. And many of Adobe's businesses are growing exponentially right now. Not talking like, oh, this business grew 3%. No. They're growing, like some of their businesses' revenues are growing at unbelievable double-digit clips. And so once again, we got another company here that people are only looking at as a negative. There's no opportunity for Adobe when there's a huge opportunity for them to expand their business much more substantially in the AI space over the coming years, right? Next year, earnings per share growth expected to be 13+% for Adobe. Next year, revenue growth expected to be over 9% for the company. Don't be surprised if they come in and beat numbers there, okay? Number 4 or 5 is Intuit. INTU on this one. Intuit, 15 forward P. Next year, earnings per share growth expected to be about 13.5%. Next year, revenue growth expected to be 12%. Intuit, man, this is a great company. Several great business lines here. One of the best business models in the world. One of the greatest companies in the world. And, there's just another one being thrown out right now. And the thing is, with a lot of these companies, I use their products. I can't replace their products. Are you kidding me? Like a good example is like Salesforce. I use Slack. I got small businesses. We use Slack. You think we're just going to be able to replace Slack tomorrow? Like, come on, man. Like, this is just ridiculous. Intuit, we've been using QuickBooks forever, right? You think we're just going to switch out of QuickBooks because we might be able to vibe code something? Come on, man. Like, what are we talking about here? It's just ridiculous. It's just ridiculous. So anyways, like, guess what? Intuit's going to keep making money for me this year and future years. Like, it's just as simple as that, right? And so I'll keep helping add to their numbers, right? Like, this just is what it is. Next up here, number 5 of 5 is, Palo Alto Networks. So this company, their stock's about $151 after hours. I looked over their numbers initially and they look pretty good. I got to do a deeper dive here. But this one's actually gotten pretty interesting. Forward P on the stock as of tomorrow should be in the 30s, right? But with, this is a company that should grow double digits for years to go in the future. And if you think about cybersecurity and the AI wave, like, this isn't going to go away. This isn't just going away. Like, come on, man. So that's another one I see as a big opportunity. There's a lot going on short term. There's going to continue to be a lot going on short term, right? Focus on the long term. Focus on great companies, adding more ownership of great companies. GVD, growth value dividends. The short term will be the short term. All these fears about this and fears about that and SaaS apocalypse and blah, 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 right? It's going to be what it's going to be. And it will pass. And great companies will remain great. They'll continue to increase their revenues. They'll continue to increase their profits, their margins, all those good things, right? And the short term will be what the short term is. So just say focus on long term. Buy companies that you're going to pat yourself on the back and say, great job for buying the stock 3 years ago, 5 years ago, things like that, right? That's what I do. Elf's a great example. Elf, 1,100% up since we bought that stock years ago, back in 2019. Elf's been through so many different growth rates the company had, so much drama, so much this, that. There were short reports back in the day, just a million different things. And yet, at the end of the day, it gave me 1,100% gain, right? And I think a lot more gains in the future. And so stay focused on great companies, stay diversified, growth stocks, value stocks, dividend stocks. There's opportunities in all three of those, and continue to build stronger and stronger day after day, month after month, year after year, okay? If you're an individual that wants access to all of my course curriculums, you want access to my private community, if you want access to exclusive weekly videos, my advanced software, 1000xstocks.com, all that sort of stuff, that will be pinned comment down there today. It's really a group mainly for $100,000 plus net worth individuals. However, you can always apply if you have less than $100,000 net worth. It just might not be the right fit for you. Once you join us in there, we'll send you your Steel membership cards, all that good stuff. We're going to talk about this short squeeze that could be coming in tech stocks. I want to share my opinions and perspectives, how big this could be, how violent it could be, all those sorts of good things right at the top of this video. Once we get done going through that, I posted this on my X page this weekend. If you ever want to follow me on X, I always have that linked in the description area down there. I said, if you had to marry one stock for the rest of your life, what stock do you pick? In this video here today, I'm going to share the stock I would pick and why that specific stock. Okay, looking forward to getting into that. Buyback growth is down significantly in terms of companies doing buybacks. I want to share my opinions and perspectives on that, as well as a few other subjects right at the top of this video. From there, I want to react to this clip here, how to protect your investments from an AI bubble. That should be an interesting one. And then the big dog at Goldman Sachs shares his opinions on where the market's headed, the economy, all that good stuff. I want to hear what he has to say and obviously react to that one for you guys here today, okay? One thing all I need from you guys, if you could just smash that little like button, okay? I appreciate you for doing that. It was Valentine's Day weekend, so hopefully this isn't the only smash you've done, but if it is, that's fine as well, okay? So I'll just smash that like button. Additionally, make sure you're subscribed here to the channel. It's free to do so, and have notifications on, because you never know when I'm going to drop a video on here. If you're somebody that has a 100K plus net worth and you're looking to apply to join my private group, that will be the pinned comment down there here today. That's access to all of my course curriculums, take you up to a much higher level as an investor than where you're at today. Get access to 1000xstocks.com, the software I use on a daily basis. Get access to our private Discord chat with the multi-6-figure members, 7-figure, 8-figure members. Get around a great group of individuals. So that will be the pinned comment down there to apply to join us in there, okay? Alrighty, so let's start off right here at the top. What is going on here? Why are they talking about a major stock short squeeze is coming in tech stocks? Well, here's what's going on. Short interest in the technology sector ETF, XLK, is up to 1.8%, the highest in at least 6 years. This percentage has doubled over the last few weeks. Furthermore, on Wednesday, investors shorted over 58 million Microsoft shares, representing 0.8% of its free float, nearing the high end of its range over the last 5 years. Salesforce CRM has 18 million shares sold short, or 1.9% of its free float. It's the 100th percentile over the last few years here. Whoa. All while short interest in the software ETF IGV spiked to 19% last week, near the highest on record. Short exposure is hitting multi-year highs. This is fascinating, right? And they show a little chart here of the XLK and short interest, obviously ballooning in a massive, massive way. So a few things here, right? A few things here. One is, just because short interest goes high does not mean necessarily the stock market's going to go beast mode or something like that. I'll give you a pretty good example. Like right here, short interest was pretty darn high, right? And yet tech stocks actually got obliterated over that course of that next year, right? So it's not always like a guarantee. Now here was a good example of, yeah, short interest went really high and you shouldn't have been short, right? Obviously, market and tech stocks continue to do very, 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 very well. Now here you saw the short interest climbing quite significantly, but then we had a major sell-off after that, right? So it's no guarantee that if short interest goes high that tech stocks are going to go up, right? Like, it's just not how it works. But it is a sign that if something happens that could be seen as really good for tech stocks in general, then you will get a short squeeze, and the short squeeze will be epic. And you'll see many of these tech stocks, especially a lot of beaten down ones, pop 15, 20, 30% in days. Not months, not years, in days, right? 15, 20, 30% moves, right? Could be extreme. But you need something to happen to get, because right now, I think people that are short in these stocks are kind of going in fearless. They're not scared of anything. They're like, we already got by earnings season. These companies are not accelerating revenue growth at a fast enough clip to justify the spend. So they're just like, we're good. We're good to short right now, right? There's also, when it comes to the Federal Reserve, the new gentleman that's coming in to lead the Fed, he's seen as somebody that's not necessarily going to be super dovish. So they're not scared that, they're going to plummet interest rates or something like that to please Trump. No fear around that. So they're really fearless right now, right? So what could what could cause a major short squeeze? It could be the Federal Reserve basically indicating they're going to cut more times than maybe people are expecting right now, right? That could be one thing. And not because the economy is necessarily really bad or something like that, just because inflation's way lower and their Fed funds rate's too high right now, right? Compared to where CPI is at. That could be one. Another could be if next quarter we start to see revenue growth rates much, much stronger. Like let's say Meta came in with like 35% revenue growth next quarter, 37%, just something that just like makes everybody lose their mind. Okay, now we're talking. If you saw AWS growth next quarter with a 3 in front of it, 30% plus, oh boy, okay, you want to watch, you want to see something insane, the momentum would be unparalleled coming back into those stocks because everybody be like, oh, this is why they're spending so much. Growth rates are exploding. If they came in and just beat numbers a little bit, put me to sleep, right? I don't think the short sellers are scared of that. If they just come in, beat numbers, it's if there's some sort of revenue growth acceleration that's way more intense than anybody has been anticipating, that is the moment that you can get just an insane squeeze. When it comes to the software stocks, I think a lot of these stocks are just going to continue to put up really good numbers as this year ticks along. And I think as the year ticks along, there's going to be less people wanting to short those stocks because they're going to realize, ooh, it's a tougher play than we think, right? Another thing that could just alleviate it is just, everybody's so, like, the whole Claude situation really, really freaked people out in a major way out of software stocks. And they think, like, everything's going to get eliminated. 80% of these apps are going to be gone and websites and all this stuff, right? And so that's leading to a lot of fear. If that just mitigates over the next several weeks, I think that can cause, because you remember what happened with DeepSeek, the DeepSeek situation, which was now, I don't know if that was a year ago, 2 years ago. People are like, oh my gosh, this DeepSeek thing was built on like hardly any, if any high-end chips. Look, no one's going to need Nvidia chips now, right? And obviously we know that's not true. So the market kind of runs with these conclusions of like, oh my gosh, everything's eliminated. So a short squeeze could happen. But it's not going to happen just by accident. There's certain things that need to happen. It could be the Federal Reserve talking about we're going to raise rates, lower rates much more quickly than people anticipate, or more. Or it could be something where growth rates of these tech companies are way higher than anybody anticipated. You get that? Other than that, honestly, I think the shorts are going to continue to be fearless, and it's going to be hard to get a short squeeze, right? So don't just bet the bank, the farm that, short interest is really high, so we're gonna, it's gonna like, these stocks are gonna pop huge or something like that. It doesn't work like that, okay? Next stock up here. I asked people, if you had to marry one stock for the rest of your life, what stock do you pick, right? And I got a lot of different responses to that. Some people, it's X, so some people were like saying Tesla, right? Which you could understand, being on X, certainly, right? Some people were talking about Palantir, and obviously Palantir's growth rates have been unbelievable. So I can understand people saying Palantir. I definitely had some Meta responses. Quite a few people said Meta, which Meta's, I think, pretty good stock to be in consideration for that. But it's still not the stock I would actually pick. If I'm thinking about something like this, I'm talking about marrying a stock for the rest of your life. I'm thinking about what company am I confident in is still going to be relevant, highly relevant, if not more relevant. Who are my kids going to buy a bunch of stuff from as they're adults, right? That's what I'm thinking about. And there's one company over all others that really came to mind. And it's not Meta. Who knows? Is Facebook and Instagram, WhatsApp, and their big platforms and threads, are those still super relevant in 20, 30 years? I don't know. Might be, might also not be, right? Apple. If the smartphone gets disrupted, is Apple going to be the company it is now? I don't know about that. It's one company, and that is Amazon. Amazon's the one company that if you told me I had to, marry that stock for the rest of my life, it would be Amazon. Because Amazon's the one, and by the way, I don't know about Amazon's setup's that great in the short term because their spending is so ridiculous, like $200 billion on CapEx this year. It's going to be heavy depreciation for years, right? And especially if they continue to spend at this sort of clip, oh gosh. So I don't think Amazon necessarily sets up great for the short term, as in like the next few months or next year or two, but Amazon sets up great for the long term. If I think about, who are my kids going to shop with? It's going to be Amazon, right? If I think about who I'm going to spend a fortune with for years and decades to go in the future, it's Amazon. If I think about who can you not try to replicate, like Amazon, right? And if I think about who's the biggest leader in cloud computing and going to be at the forefront of all these AI companies, it's Amazon. So that company just sets up very, very well. That's the one company that if you told me how to marry it, because I don't think like that. I'm a long-term investor, but I'm not thinking about 20 years out, 30 years out. You know why? Because, dude, you have no clue and I have no clue what companies are going to be relevant 20 and 30 years from now. It's too far in the future, right? Too many variables can happen. Too many things can happen. Too many disruptions can happen. It's just unrealistic. I think in terms of long-term, as in like the next 5 years. I'm thinking about what companies are going to make bank the next 5 years that are great valuations that can set themselves up, right? That's the way I'm thinking. Next 3 to 5 years. That's my long-term thought process. And then thinking about my portfolios over the next 50 years, right? But in terms of individual companies, you just don't know what companies are going to be the hot thing or not the hot thing 30, 40, 50 years from now, right? So that's where I differ from somebody like a Buffett. You know, Buffett, so people say, okay, he's more of a guy that buys a stock, take it to the grave. I don't really think that long-term, you know. Like, sure, I want to buy companies that I could be pretty confident in are going to be super relevant, highly relevant, 30 years from now. But like, it's just so hard to see. I'm thinking about the next 5 years, much easier to see in regards to that, right? S&P 500 buyback growth is showing signs of slowing down as of last quarter. Who's replacing it? Upsized AI, or what's replacing it? Upsized AI CapEx spending. Keep a very close eye on this trend, right? Yeah, I mean, it's just simple math, right? These companies like Amazon, Meta, Google, they don't have any extra money around. When you look at how much they're going to be spending on their CapEx this year, there's not a bunch of money just laying around to go do share buybacks with. They just can't do it. So when it comes to all these companies that are spending, Oracle, you think Oracle's going to be able to do share buybacks? No. Like a lot of those big tech companies that are spending heavily right now, they just can't afford to do share buybacks, right? So that takes them out of the market. On the flip side, I think companies that can set up great to do massive share buybacks over the next few years, you know who they are? Nvidia, AMD, because Nvidia and AMD are going to make bank for the next several years, right? And so what are they going to do with all that money? They're going to do share buybacks likely, right? Apple's also in a good position to continue to do share buybacks. We know their profitability is amazing at that company. It's not like they're spending fortunes on CapEx. So they're going to be able to continue to upgrade that dividend over the next few years, do massive share buybacks. But in terms of a lot of the big tech companies, they just can't do it. You know, the Metas, the Googles, Amazon's, companies like that, they're the companies I think are going to be able to do big buybacks also. Big buybacks. And if I was these companies, I would accelerate buybacks as much as I could for the next 24 months. You know who they are? SaaS companies. Valuations are dirt cheap. Those companies are insanely profitable. And they don't need to spend fortunes of money on, building AI data centers and all this stuff, right? Those companies can really continue to build their businesses and their products and their services on the back of AWS, on the back of Azure, on the back of, Google Cloud. And so, yeah, those companies would be fine in regards to that. So, but it is something to keep in mind. Right? This one, Joseph Carlson posted this, said Goldman just said that Duolingo, Little Dingo, is an AI loser and said it's a sell. Here's a performance from when they called Netflix a sell, right? Now, I thought this was worth mentioning here. And the reason being is just because one stock has done well in the past and somebody said it was a sell doesn't mean the next stock's going to do that, right? And so let's be honest, there's a big difference between somebody like a Duolingo and somebody like a Netflix, right? A Duolingo is like a niche product that, how many people are really going to stay signed up for Duolingo for the next 5, 10, 15, 20 years? I don't think there's very many. I don't think that's a big statement. Like, sure, there's a lot of people that might try out a product like that and like, oh, I think it would be fun to learn Italian. Oh, I think it would be fun to learn Spanish or, whatever, right? I'm going to learn French. Okay. And they sign up for a bit and they kind of mess around with it and they pay a little bit, or maybe they don't pay and they just see ads or whatever, right? And then eventually they stop using it. Netflix is not that sort of company. There's a huge difference here. Like, Netflix is the type of company that when somebody signs up, like they're going to stay signed up 5 years out, 10 years out, 20 years from now, right? Unless somebody comes and replicates Netflix's whole business model, which isn't super realistic. Duolingo's not that sort of company. People might sign up for the product and try it out and then not use it anymore. Or they might start paying and then, 6 months later, they're going to stop paying, or a year later, or 2 years later, or something like that, right? Netflix, that's a hard one. Like once people sign up for Netflix, to get them off that Netflix account is difficult. Like Netflix would have to go up dramatically in price. And so Netflix, when they capture a customer, they probably have a customer for the next 20 years, next 10 years, right? Duolingo's not that same company. So I think that's very, very important to keep in mind here. But I think it's natural sometimes for investors to say, well, this analyst or this company, they said this was a sell in the past, and look at it did so well, so this other company and things like that. But, I just see massive fundamental differences between a certain company like that and somebody like a Netflix, right? Next one up here. So Amit was in the news this weekend because he was going at it with Burry. First off, before we get into that, and then I actually want to mention this as well. The whole thing with Burry and Amit, they were going back and forth on X. And I know for people that aren't on X, you're probably like, what the heck's going on here? But for the people that are really into that X community and the stock market space, right? Amit and Burry were kind of going back and forth there. My opinion on the subject is I think Burry used Amit for publicity. That's just my personal opinion, right? At the end of the day, Burry has that, I don't know if it's called Substack or whatever, right? Which, can charge people to access this Palantir bear case. So Amit is super well known in the Palantir community. So if you want to get a lot of people to come see this bear, thesis you have, well, why not go after somebody that has, the whole Palantir community behind him, right? Because all of a sudden that's going to attract a lot of people, and those people are going to be like, oh, let me just pay and see what he has to say about Palantir here, right? And I bet you he got a ton of new members from this. So I think he kind of used Amit in this situation. That's my personal opinion. I could be wrong on that. That's just the way I see it, okay? But, who knows? It is what it is, right? Now, this one I actually thought was interesting, and I thought I would discuss this. The stock market being closed takes away most of the purpose from my life, right? And that happens to a lot of people. And to that, I say, listen, ladies and gentlemen, okay, as Mr. Stock Market here that's been doing it for 17 plus years, listen, you got to have passions and things outside of just the stock market. That's not healthy. And that's not healthy. If everything just falls on the stock market, like, I don't think you're living a healthy life, right? Like, if I look at myself personally, like, stock market is such a huge component of my life. Running the private group, running these YouTube channels, right? Being an investor for the last 17 plus years is so much fun, and it's a huge part of my life, but that's not the only thing, right? Got a wife, I got kids, I got hobbies I like, and different things I like to enjoy in life. And so you never want to be one-dimensional in this life. There's so many things you can enjoy. And I've seen plenty of people, even family members or friends and things like that, they're just one-dimensional, and they can only enjoy like one thing or get purpose out of one thing. And I think it's important you're always exploring yourself. There's more to just one thing, whether it be the stock market or something. It's more than just one thing in this world and in this life, man. There's so many things you can enjoy, okay? Alrighty, let's get into these videos.
Confidence in AI now wobbling.
In recent weeks, we've seen big companies announce that they're going to spend absolutely jaw-dropping amounts of money investing in AI. And whereas previously investors were cheering those announcements, actually, lately, we've seen the stock market wobble in response. It seems like they're getting a bit worried about whether they're going to get returns on all of this money that companies are spending on this new technology.
So what exactly is it that's making the stock markets jittery?
Well, it's not just that investors are worried about the amounts that companies are spending, although those amounts are vast. It's kind of this feeling that we've been here before. So there are lots of times throughout history where you've had a new technology emerge and it looks like it's going to transform the world. So take railways or canals or electricity or the internet. And in all of those cases, the new technology actually did transform the world. But in the early stages, when it was just coming out, investors got overexcited. They ended up bidding up companies' share prices out of all proportion with their underlying profits. And they also ended up picking the wrong firms, not buying the companies that would actually benefit from this. And then even when the new technology was really successful, a lot of investors lost an enormous amount of money. And there's kind of this worry that something similar is happening again, that AI might be this transformative technology, but share prices have been bid up out of all proportion with underlying profits.
So we're at a very nervous moment. What is it then that investors can do to avoid getting stuck?
This is something of a puzzle, because you might think the obvious answer is, okay, shares are too pricey, so I'm going to sell my shares. Professional investors often don't have that as an option. For example, if I manage a stock fund and I tell clients invest in my fund and I'm going to invest in stocks, I can't just suddenly sell them and sit on a pile of cash. I might actually not be allowed to.
Listen, ladies and gentlemen, very important, okay? What companies you pick matters immensely as a stock picker. You can't just see a trend and be like, this is a big thing, and so therefore all the companies are going to be winners. No. Anthropic might be the big winner of AI. They might not. They might be irrelevant in 5 years. I don't know. Same thing with OpenAI. Same thing with all these companies. Some are going to be the huge winners and some are going to be huge L's. And I'll show you, like, for instance, social media. Social media, like, over the past 15, 20 years, right, you knew social media was going to be a big thing. Like, everybody's talking about it. It's like guaranteed to be a big thing, right? But look, Meta, since its IPO, is up 2,000+%. Meanwhile, Pinterest, right, 50% down. Snapchat, 78% down. X, which was formerly known as Twitter, that stock always sucked. Horrible stock. So almost everybody was L's, and one company actually was a winner, chicken dinner. It was Meta, right? And this is what's very important. And so when it comes to this AI game, you better understand, like, somebody, is going to win huge. Somebody will be the Meta, but there's going to be plenty of losers. And when they go IPO, like, whatever you buy that stock at, you're probably going to lose money over the next 5, 10, 15, 20 years. That's just the way it is. If we think about the search engines, like, I always give this example and kind of date myself when I do this, right? I used to use Yahoo Search. I used to use Ask Jeeves, right? And who ended up winning was Google. Huge. Whatever happened to Ask Jeeves? I don't even know. But that was like, we were using that back in the day. Whatever happened to Yahoo Search? I don't know. Like, I think it's still around. But it's like, who uses that? Like, everybody Googles stuff, right? And so this is very important to understand this. Very, very important. If we think about cell phone makers, like, there was a time period when everybody was using Nokia. There was a time period when everybody was using BlackBerry, and who actually ended up winning long-term ended up being Apple. And the other company that ended up really benefiting huge from cell phones was a company you would never even think of, really. And it was Google, right? Because they launched they didn't launch. They bought a company named Android, obviously, right? And that became the biggest OS in the world when it came to cell phones. So sometimes some of these companies can succeed that you never could have foreseen. They're like, wait, that company ended up becoming huge in this space? Like, how did they end up doing that, right? So anyways, what the point he makes here is fair, very fair.
Even if my client's going to ring me up and say, what are you doing? This isn't what I'm paying you for. Even for individual investors who can make the decision to sell their stocks, it's not necessarily a good idea. So take a previous boom, the dot-com boom, which ended in a crash. There were lots of wobbles on the way up, and at each wobble, nervous investors might have decided to sell their stocks. But actually, over the course of that boom, share prices rose by a factor of 12. So you would have really regretted selling your stocks on the way up. And in fact, even after share prices plunged, at the bottom of the crash, investors who had just held on through the ups and the downs would still have made money. Those who had sold out early wouldn't. So selling your stocks isn't necessarily the right thing to do, even if you think share prices are too expensive and you're worried about a crash.
So if selling up doesn't make sense, then what else can investors do?
Well, the classic way to hedge stock market risk is with bonds. Buy some bonds alongside your stocks. And the reason for this is that bond prices historically have tended to go up when stocks have gone down. So they've cushioned losses. Now, again, looking back at that previous boom, the dot-com one, investors who had hedged their stock market risk with bonds did very well throughout that period, because actually bond prices went up as stock prices went up, although not as much. And then when stock prices fell, bond prices rose. So they didn't hurt your profits too much on the way up, but they did compensate your losses on the way down. The trouble today is that we've seen this old relationship break down a bit recently. For example, when stock prices crashed in 2022, bond prices crashed along with them. And what was behind that was the worries were about inflation, and inflation can hurt the prices of both of these things. So if we got a similar crash today, and lots of investors are quite worried that inflation might cause a crash today, then bonds might not be as effective at protecting people's portfolios as they were in the past.
And what about an even older haven, gold?
Yeah, well, it's done very well recently. And as you say, this is a time-honoured hedge against chaos. What makes people worried about gold just now is counterintuitively just how well it's been doing recently. It's gone on a roaring bull run over the past year. At the start of this year, traders talk about prices going parabolic, just shooting up and seeming to go towards the moon. What can happen after that, though, is very large swings in prices. And we actually saw that a few weeks ago. The gold price dropped by about...
So very important you understand her is when you're going through a boom time, it doesn't mean every single week, month, or anything like that is going to be straight up. And so there's the AI boom right now, right? That's what we're talking about here. But the thing you got to understand is even let's say in the tech bubble time period, right? When, it was like, oh, the internet's going to become this big thing. Everybody's going to have a computer, blah, 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 right? There was plenty of time periods when for several months, the market downtrended. And you could have thought oh, this is the end of this particular cycle, right? And at the end of the day, obviously the market just kept going up. And then we had a blow off top scenario, right? And then there was a big downdraft from there. But I don't love when we equate things back to tech bubble time because it was just very, very different, man. There was not a bunch of companies making huge profits at that particular time, right? Those business models were very, very different than the business models of today, right? So just something to keep in mind there. Are there potentially huge risks in the private market with the way they're valuing some of these companies? I think there is. OpenAI, if they got $1 trillion valuation on that over time, okay, maybe they justify that. Maybe they grow into 5 trillion to 10 trillion, something like that, right? But who knows? Maybe they become somewhat irrelevant over the next 10 years. Have we considered that? Right? Same thing with Anthropic's. Anthropic's a hot one right now. That might be, the one that is the next $10 trillion company, or maybe it's irrelevant in a few years. So I think to pick some of those is difficult.
9% in a single day and then swung wildly afterwards. When you see an asset that is supposed to be a hedge behaving like that, you might feel a little less confident that it's actually going to be a hedge. If it can swing so wildly, is it really a safe haven?
And are there any other alternatives then?
Again, counterintuitively, perhaps the best way to hedge stock market risk is with other stocks. So I looked at a study that analysts at Goldman Sachs did recently on hedges that would have performed particularly well during the dot-com bubble. And intriguingly, they found that some of the best ones were select baskets of stocks. So, for example, stocks that pay very high, reliable dividends. So they offer you a reliable income. They did well on the way up and the way down during the dot-com crash. Stocks with low volatilities, this kind of dependable old companies. It might feel a little unsatisfying to say the best way to hedge your stock market risk is with other stocks. But when you look at the alternatives and how these have performed in the past, it might be the best that investors can do.
100%. And that's why, what do I preach? You watch me religiously, you already know what I preach. GVD. Growth, value, dividends. I don't just build a portfolio. And if you're part of my Patreon or if you're part of my private group, right, and you see those portfolios, what do they consist of? Growth stocks, value stocks, dividend stocks. I don't just go all in one category or one type of stock or something like that. Stay very well diversified. And so at any given moment, I might have some stocks in the portfolio that are going through trouble, right? Those stocks just aren't doing well. Meanwhile, I got other stocks doing tremendous. And the goal is just having those stocks do a lot better than doing bad over time, right? As long as we do that, which is what we do, the portfolios just grow bigger and bigger and bigger over time, right? And sure, they go through short-term dips when, it's public count's going through a tough time right now, it's down blah, blah, blah amount from where it peaked at, blah, blah, at this particular time. That happens all the time, right? And it's like, okay, and then all of a sudden it starts going through another upswing. Next thing you know, it breaks through a new all-time high, and then it breaks another all-time high, and then next thing you know, it's just record breaking left and right. And it's like, oh my gosh, it hit this level, it hit this level, it hit this level, right? Like, that's the name of the game. You've got to stay well diversified in this over time. All right, next one up, the big dog, Goldman Sachs, arguably the most important investment bank in the world.
It's been 8 years.
It's we're in the eighth year, Joe.
I think there were a couple of years where maybe you wouldn't have wanted to be out here at a golf tournament, maybe.
Yeah, I mean, there are times when I think it's great to be out here, and there are times where you've got to have your head down and focused on.
I mean, I'm looking at
the matter at hand.
Every metric, Goldman Sachs is up in market cap. I'm
really proud of our team, Joe. It's been a real journey, but we've really worked hard as a team to grow the firm. And as we've grown the firm, we've put more financial resources in front of our clients, and we've grown our client franchise, we've grown our market shares, we've grown the earnings of the firm. And when you grow the earnings of the firm, the market cap follows. And so we've got extraordinary people at Goldman Sachs. They've done an extraordinary job, and we're very excited. It's a complicated world at the moment, but we're very excited about the opportunities for our firm.
In so many ways,
looking forward.
Complicated, David. I mean, do you need to hire a bunch of young people to tell you what to do with AI? Are you ready to face the future in how to steer Goldman Sachs into this world?
Well, like everybody else, we're adapting to change in the future. And one of the things I know about organizations is organizations hate change. But one of the responsibilities for leaders, in organizations is to figure out how to help organizations evolve and change. Young people, young talent is always going to be a huge core part of Goldman Sachs. And, the way they work and the way they're trained has been evolving over the 40-some years that I've been doing this. You think back to when I started, there were no computers.
Yeah.
We were in the library, we were in microfiche, then we got a desktop computer.
Pager, if you were lucky.
I didn't get a page until the 1990s.
Yeah.
Back when I started.
So you could go to a payphone and find some change to return the call.
I'd be on business trips and I would get a page, with a little, analog, number, showing.
Nice.
You have to go return that phone call. And so the world evolves, people's work changes, but talented, motivated people that want to serve clients are always going to be a part of professional services businesses, but the mix will change, the number might change, how they focus their time will change and evolve, but that's not inconsistent with what's been going on, for the last 50 years and longer, candidly.
What's 2026 look like for you?
The macro setup is quite good. I've talked about this extensively, including when we were together in Davos. You have this combination of strong fiscal stimulus, here in the United States. And by the way, in most developed economies, you have a pretty significant capital investment surge around AI and this technology, which is obviously, very, very stimulative to the economy and to economic activity. We have a huge deregulatory swing, in the U.S., which is also constructive because when the regulatory pendulum swings hard the other way, people have to invest more in meeting those regulatory obligations. And when it swings back, there can be more balance in that. And therefore, those resources can be freed up to invest in, more productive parts of the business. And so you're seeing that swing. That's a tailwind for economic activity. And so, we're sitting in a place with a pretty constructive environment. And I personally think if you look at Jan Hatzius, our economist, he's got 2.9% real growth this year, 5% nominal. And just kind of the consensus, and that's on the the higher end of the consensus of all the economists out there. But the consensus, as I talk to people, is that we could see better than that. So you've got really strong tailwinds for good, nominal and real growth. And I think a lot of deal activity. I heard Jimmy talking about deal activity. I agree 100% with what he said about the fact that we're in an environment where if people kind of imagine something strategic, they can at least go have a discussion about it and see whether or not it's a possibility. And that's not the way it's been for the last 4 years.
Do you remember days when there would be...
So if the economy is really good in 2026, what does that mean for the stock market? Does that mean the stock market is going to go ballistic this year? Does it mean bad things? Listen, it certainly doesn't mean bad things, right? If the economy is bad, that means bad things usually for the stock market, right? But not always also. But it doesn't mean bad things. Also, like, people are under the assumption, well, if the economy has a great year this year, it means the stock market's going to have a great year. Not necessarily. Like, never forget who runs the stock market. It's the biggest companies out there, right? So if there's worries about those companies because let's say their growth rates are beating, but they're not beating by that much, but they're spending so much and they can't do share buybacks. And so there's not a lot of excitement around the stock prices, right? Well, and there's not a lot of optimism about the stocks. Like that means the stock market's not necessarily going to go through a year where it has a 20% return. Like it's just not how it works, right? And so, no, that can mean other companies that maybe have struggled in maybe a weaker economic environment. Let's say you have the thought process that it's been a weaker economic environment over the last several years because we had all the inflation and things like that, right? And let's say you believe the economy is actually getting a lot stronger over the next year or two, right? There's going to be a lot of companies that thrive that have been beaten down dog stocks the last few years. And I think about companies like Nike. I think about companies like Estee Lauder. I think about a lot of those sorts of stocks that have struggled that honestly could benefit in quite a substantial way if you have a stronger economic backdrop and people can actually go afford to buy a new pair of shoes, right? And afford to maybe go a little higher end when it comes to cosmetics and all that good stuff, right? Which benefits somebody like an Estee Lauder. So yeah, it just, there's different stocks in different places. If the economy's a little stronger, a little better, right? Companies like Caterpillar definitely fit that agenda. And I mean, Caterpillar stocks had an amazing year already. Caterpillar this year has given you unbelievable returns. Oh, another stock that is great under a stronger economy is a stock named Cake, right? And Cake's already off to a good start this year. It's already up 11% so far this year. But Cat's on a whole different level. Caterpillar stock's ridiculous. Look at this year to date. 29% return. So it's given you, it's already been a great year for Cat. Like you could take your profits on Cat and be happy already because you're like, oh my gosh, the stock's, amazing. So yeah, anyways, that kind of is the way to think about the economy and the market.
Every couple of days that we'd be talking about.
I remember those days. You can look at a period like 2021 when there was sponsor activity and SPAC activity and there were IPOs every couple of days. You can look back, at the 1998, 99, 2000 period. I think we're going to see more IPOs this year. I think we're going to see potentially some very, very large IPOs, unprecedented in size. But I do think I'll never say never again because, never's a big word. And
the big IPOs coming out, that's not necessarily great news for the market or for stocks. That sucks money out of other places. Like usually if you got a big IPO, let's say OpenAI is going public 2 weeks from now, right? Just throw that out there. And then let's say SpaceX is going public, 2 weeks after that. Not happening, but let's just say that happens. You're going to see a massive amount of selling in a lot of other big tech stocks and other stocks in general to get ready to go into OpenAI, to get ready to go into SpaceX. It's just what happens. A certain percentage of investors or traders want to buy the new company when it goes IPO. They think, it's going to go up a lot and those sorts of things, right? And so they get excited. They sell out of other positions, leads to a lot of selling pressure on other stocks and goes into, those new stocks, which is not, once again, it's not necessarily a good thing for the market or a lot of these other stocks. There's something to keep in mind there, right? And we're going to have some big IPOs coming. I don't know exactly when they're coming, but I'm sure Anthropic's at some point is going to go public. I'm sure OpenAI at some point is going to go public. Perplexity maybe. SpaceX at some point in time. But I don't know what's going on with that, with the XAI. We'll see, what Elon's up to there. But I wouldn't be surprised, if they go public. And that's usually a sign you've went through a nice bull run. And we've been on a nice bull run the last 3 years. So it's kind of natural that the IPO environment should, in theory, heat up over this next 6 to 12 months, right? All right, guys, appreciate you joining me. As always, thank you so much for being here. If you're an individual with 100K plus net worth and you want to apply to join my private group, that will be the pinned comment down there here today. If you have less than 100K net worth, you can still apply to join us in the private group. You just might not be the best fit to join us in there. That's full access to all my course curriculums, take you up to the highest level to teach you everything I've learned up here over the last 17 plus years. Get access to our Discord chat so you can keep up to date with everything going on in the market with your stocks, as well as getting access to all the amazing members we have in there, exclusive weekly videos from me. So much you get access to. 1000X, which I use on a daily basis, all that good stuff. Okay. Much love and have a great day.